All right, here we go. All right, so let me know when you guys can see. Actually, 1 second. All right, can you guys see my screen? Okay, here we go. All right, so me and Nez, we're doing this boot camp throughout this whole weekend, and really the main objective for it is to give you guys like a full breakdown of everything we look for when it comes to technical analysis, and like everything from the basics up into the advanced portion of it. So technical analysis is not, something that it's going to click overnight. It's going to take quite a while, and the more repetition you have with it, the better you will become um, within a faster time period. So here we go. Okay, so first, quick disclaimer, not a financial advisor, not giving you financial advice. This is for educational purposes only. And really, what we're doing is giving you the resources so that you can go and execute these trades on your own, and you know what to look for, you know what to do and what not to do, and it'll help you with precision down the line. It'll help you become a profitable trader. So like when it comes to investing, it's always important to invest at your own risk, trade according to what you see, and also take accountability with it, because we're really trying to grow people into independent traders and not people that depend on someone else to give call outs every single day. Because let's say something tragic happens to one of us, then you're going to be on your own. And then you need to understand how to utilize all these resources to your advantage. Then if you guys have any questions, feel free to put them in the chat. Okay, so this is day one. So everything that I'm going to go over today, we're not going to get into the nitty gritty. We're really going to focus on like the overview, like what all this means, like our purpose, the resources we're looking to use, the criteria we want to look for. And then also we want to get an understanding of the concepts that we're really going to take into perspective and use for our benefit. So the first question that you should ask yourself is, why technical analysis? Why am I taking an hour, 2 hours out of my day to learn this stuff? And it's really for risk mitigation, identifying entries and exits, using the history to predict the future, and also give you a higher probability on becoming a profitable trader, and giving yourself a higher probability of actually having a better understanding of what you're doing. Because you can simply just take our call outs and become a profitable trader, but it's not beneficial to you if you don't understand the ins and outs and the intricacies of what you're doing, why you're doing it, and why it makes sense. So this is why you want to look at technical analysis. So when I first started trading a couple years ago, the first year I never used technical analysis. And yeah, I was profitable, but at the same time, I had no idea what I was doing at all. I was just simply guessing, saying like, I think this stock will go up this week or go down this week. I'm going to buy some calls. I'm going to buy some puts and just pray for the best. And it works sometimes, but it doesn't work all the time. So you really want a better understanding of this, so you know exactly what to look for. That is the key. The key is to understanding the details, why things work and how things work. And this will benefit you in the future. Okay, so when it comes to charting, the main resource is TradingView. TradingView.com is a free website, and this is where we do all the charting. So what we're going to do right now is we're just going to go through a brief rundown of what TradingView is, how to utilize it, and what are the most important tools to use when looking at TradingView, because it's going to be really confusing if you've never looked at it, and not everything on TradingView is important. So let's see. Okay, so this is tradingview.com. So all we did is go to TradingView, click on the website, and typed in a stock. So you have your stock name up here. This is your symbol search. This is where you can look for any single stock, any crypto, Forex pairs, whatever you want to look at. It's all up here. So next to this, you have your time frames. So these are these numbers right here. So when you click on this arrow, you have a breakdown of large time frames, and it gets smaller and smaller. So the larger time frames are going to give you a more broad overview of what is happening with the stock. So let's look at a stock's movement. So for example, we're going to start with Apple. So we're just going to make this a line. So if we zoom out, we see overall Apple, goes up, goes down, goes up, goes down. And this is in a 1-day time frame. So now if we move it back to the candles, this will show the exact same thing. All it's showing is how the stock is moving. Now, when we go to a smaller time frame, for example, 1 hour, overall, we get the same thing, but we get more details. So think of you going in smaller time frames as using a microscope to look at something. So when you're looking at it on a 1 day, 1 week, or 1 month time frame, what you're doing is looking at it with the naked eye. And now that you go to the 1 hour, you're starting to use a microscope. And then when you go to 15 minutes, the microscope zooms in even more. 5 minutes zooms in even more, and so forth. So the smaller the time frame, the more precision and the more information you get. The larger time frame, the more holistic view you're looking at. So out of the time frames, the one that I like to use the most, and this is why I have them starred, is the 1 day, the 1 hour, the 15-minute, and then the 5-minute. Now, when we're going to look at these later on, we're going to dive into why I look at these, because they all serve different purposes. But for the matter of right now, all we need to focus on is understanding how these timeframes work. So let's say we're looking at playing options or stock trading on something within 1 week time period. So from a Monday to a Friday. Are we going to look at it in a 1 day time frame? It's not going to make a whole lot of sense, because we need a lot of information to determine what we should do throughout the week. So if we're looking at a 5-day time or a 5-day time period in a 1 day time frame, we're only going to get 5 candles. It's not going to tell us a whole lot. Whereas if we look at the 1 hour time frame, we're going to get 8 candles for every single day. So within a week, we're going to get 40 candles, 8 times 5. And this is going to give us just the right amount of candles. We're not going to get too little, we're not going to get too much, just the perfect median. Now, let's say we're looking at trading something within a 1 day period. So from 8:30 a.m. to 3 p.m. I would more than likely use a 15-minute time frame. Why would I look at a 15-minute time frame? It's going to be because we're going to get the right amount. We're not going to get too little or too much. So with like a 1 minute time frame, you're getting a candle every single minute. That's just too much information. Maybe if we were looking at trading something within, I don't know, a 30-minute time period, yeah, that could be beneficial. But for the span of 8 hours, 15-minute time frame is pretty efficient. Now, let's say we're looking at trading something shorter, maybe like a 2-hour time frame, 2-hour time period. We're going to look at a 5-minute, 3-minute, 1 minute per trade that gets smaller and smaller and smaller. So this is what all the different time frames are for. And then you got your seconds, and I never use those. All right, so just based on everything we went over so far, which is the time frames, does anyone have any questions on that? So I just want to make sure everyone has the same understanding before we move forward. Yeah, we'll get into that later about the rewind. How can you start the time frames? So you want to click this arrow, click down, and you'll see the stars pop up next to it, and you just click it, and it'll be starred. All right, so this next section on Trading View, right here we have our candles and lines and our bar styles. So if we click this arrow, we have all of these different options of how to view the stock's movement. We can view it in a line, we can view it in an area, we can view it in Hekanashi. All I use is the candles. That's it. That's all you need to use, nothing else. Okay, so now that we have that, now we want to get into how to utilize our tools. So with our tools, there's many different things that we can utilize, and there's also a lot of things we just don't have to use. Because the way I like to do things is I like to find the simplest way, but yet efficient way to do something. So here you have your trend line. Your trend line, if you click it, you can move it in any direction you want. It doesn't matter if it's up, down, anywhere. So I have this starred because I use it. All these other ones I don't really use other than the horizontal line. The horizontal line, wherever you click it, it'll create it there, and you can move it up and you can move it down. Now to the lines, those are only two I utilize. Geometric shapes. I like the triangle, not the triangle, but the rectangle. It's just you can create a shaded area. And that's what I like to use that for. And here we have other things that aren't necessarily too important. So for example, a price label. If you click it, it'll show the price of this area. And wherever you move it, the price will move with it. So just like that. And then out of those are really the only ones I like to use. And then we also have a marker up, and we have a marker down to represent an upward movement or a downward movement. All right, let's see what questions you guys have. So for 1 week options contract, what time frame is recommended? So I would use a 1 hour time frame if we're looking at something, playing something within a week. And then as we're looking per day, then you want to use a 15-minute time frame. Sorry, now let's go back to the slides. Okay, so we just went over the basics of how to use TradingView and what tools we want to utilize. So now we need to understand what criteria do we need to look at when it comes to technical analysis and trading options and everything of that nature. The first thing is you want to have patience. This is all a patience game. People that are patient get rewarded. Patient pays. If you're, super antsy and trying to jump on every single opportunity without, taking a step back and looking at it from a more clear head, then it's just going to be a lot harder. So you always want to have patience with this. Everything isn't going to become instant. It's not instant gratification 24/7. There may be some instances that, allow instant gratification to be there, but it's not always going to be there. So don't bank on it. So now the next thing is you want to understand, what type of stocks do you want to trade? What fits for you? What fits for your budget? Are you looking to trade long term, short term, or somewhere in between? So for me personally, I like to look at large cap stocks. And the reason I like to look at large cap stocks is because, they're super volatile. They can move $4 in a day, $10 in a day. So there's a lot of opportunity there. Whereas if you're looking at, I don't know, like a smaller stock, like for an example, a stock that isn't as volatile. So like AT&T, for example, within a day, it's maybe going to move 30 cents, 20 cents. There's not a whole lot of opportunity that you can capitalize on. So you really have to hone in on what works for you. And that's why you'll see with a lot of the plays that I put out, I really just play the same basket of stocks over and over and over again. Because once you get a clear understanding of, okay, this stock moves like this stock moves like this. So you can identify what you want. It's really like going shopping. Like you understand what you like and what you don't like, and you just stick to what you like. So now the next thing is identifying your ETFs. So think of this as the stocks as the children and the ETFs as the parents. So as the ETFs move, the stocks will somewhat follow that movement. So let's say, for example, SPY, the S&P 500 is, going on a sharp decline. As we've seen this past week, we saw a lot of stocks go on that same decline and go down throughout the week. And this is because this tracks the overall market. And we have a bunch of different ETFs. You have the NASDAQ, Dow Jones, SPY, and many more, but really I only pay attention to SPY. So now the last thing when it comes to criteria, we want to look for opportunity. If the opportunity isn't there, you just don't want to take it. It's perfectly fine to not trade every day. Me personally, I don't. There are some weeks I trade every single day, but there are also some times where I do not trade every single day. It doesn't take, 4 good trades every single day to be consistent and really good at this stuff. Really, if you have 2 good trades within a week, pat yourself on the back and go on about your day. Like some people, they'll complain about, like, oh, I only grew my portfolio 10% this week. That's really good. A lot of people, struggle to do that within a year. So like if you just took that 10% for the week and you never trade for the rest of the year, you'd be on track to be doing pretty well. Got a 10% increase on your money, whereas it could just be doing nothing. So you always want to wait for that opportunity. And this also ties into patience. If you don't have the patience, you won't find the right opportunity. So the third criteria is looking at your ETFs. So the first is patience. The second is identifying what stocks work for you. So for me, I stick to large cap, mainly tech stocks, because they move. They can move within a range. Third criteria is your ETFs. Fourth criteria is seeking opportunity, waiting for an opportunity to come. Yep, I trade SPY sometimes, not all the time though. Okay, so now we're gonna get into, actual practice. So we're diving into the concepts. So when we're looking at our concepts, this is the foundation and the basics that are gonna take you from being an amateur trader, someone that doesn't necessarily know what to look for. Like this is really going to be your foundation. This is something that you want to remember. You want to, have an expertise on support, resistance, trend lines, and breakouts. This is the forefront of what I base all of my trades on. And this is how, like mastering these 4 things, this is how I've become the trader I am today. And it's really through repetition and always pushing yourself to be better. All right, so support. What is support? Support is a point at which a downtrend ends due to a concentration of demand. So for example, let's say the stock is falling down. We hit a level, we bounce up. We go down again, hit that same level, we bounce up. That's what support is. So for an analogy, let's say one of you guys stood up, you jumped up, landed on the floor. You're not going to fall through your floor. At least I would hope not. And think of your floor as your support. So it is your base level. So now the opposite of that is your resistance. Your resistance is a price level at which a stock struggles to break above. So if you stood up again and you jumped, you smacked your head on the ceiling, you're going to fall right down. It's going to hit it, come right down. So when we're looking at stocks, this is just a level where the stock hits, comes right back down. It struggles to break through that area. Now, our trend line, this is a line that's going to show a direction of a stock. So think of this as like your rails. So if we have a stock moving in an upward direction like this, and it's moving within a range, it's going to look like this. So the stock is going to move in between these trend lines as it moves in the upward direction, or it'd be the same, but for a downward direction. And then lastly, we have breakouts. And this is just the stock moving to the upside or downside, in a strong direction. So it's really just breaking a support or resistance level. So now let's go back to TradingView and let's find some real examples of support, resistance, and trend lines and identify how to use them. But before we do that, let's look at what a candlestick is. So when you look at a chart, it might look super confusing with all these red and green things, and these are just called your candles. So the most important thing to understand is for green candles, this is showing the stock moving up. The red candles is showing the stock is moving down. So these lines that are coming out of the candle is called your wicks. So for red and green, the top of the wick is going to be your high. The bottom of the wick is going to be your low. Those are the same across the board. Now, when it comes to the rectangles within it, you have your open and close, and it's just flip-flopped for red and green. So, okay, now let's go into TradingView and look at support, resistance, trend lines, and a couple examples of some breakouts. Should advise the stocks follow ETFs? Yeah, essentially. But with a stock, it has a lot more things that can go into play rather than the ETF. So for example, for Apple, if we're looking at Apple following the NASDAQ, if the NASDAQ is pushing down, Apple is more likely going to push down with it. But Apple is a company. So Apple is, they could be affected by numerous amount of news. Let's say Apple drops news that they're pushing out 5 different iPhones throughout the next year and I don't know, all this good news, then that can make Apple go against the trend of the NASDAQ. So overall, as we look at a company and an ETF, there may be some similarities, but it's also important to keep in mind that companies have they just have so many factors that can change the way it moves. All right, so let's look at a 1-hour time frame on Apple, and let's find some examples of support and resistance. So when we're looking at support and resistance, we're going to look at our wicks. So remember, the lines that come out of the candles. So our highs and our lows. We're going to look for areas where we have common highs and common lows. So let's say we have a line here and a line right here. Let me know if you guys are following me. Let me know if I'm going too fast or anything because I'll slow it down. Okay, good. So when we're looking at these two lines, this path is going to represent the stock moving up and down. So here we have one example here. And now let's create another example. Say the stock is moving down. And we're just moving in between this range. And now let's just do one more. Let's say it's moving upward. Okay, so all these examples, the stock is moving in different directions. We have a direction where it's just moving sideways, a downward movement, and an upward movement. Now, the thing that is common with all of these is it's all support and resistance. All of it is. So remember, resistance is the level where the stock struggles to break above. So this would be our upper line. Our support is where the stock struggles to break below, or where the stock bounces at. So that'd be here. So looking at this example over here, it's the same thing. It's just going to look a little different. It's just going to follow the way the stock is moving, just like this. And now for this upward, we have our resistance. And then the bottom, we have our support. So this is what we're going to look for. And we're going to use our wicks to identify how it's going to look. So let's draw up one example so we can actually have a better understanding. So let's say we have a green candle right here. I'm not an artist by any means, so please don't judge. Okay, so here we have a wick here and a wick there. So this is going to show resistance because the stock hit this level, came back down. Our support is going to be right here. The stock hit this level, bounced up. So now when we're actually looking at it, let's just focus on this area right here. Just this. Okay, so now that we're looking at this, we can see if we take our rectangle, let's see, so we can see about right here. This level is acting as support right here. So you can see we're bouncing in this level. Another example, we can see we have support around this area because of the bottom of our wicks are hitting this line multiple times. And this is in a 1 hour time frame. Another example right here, we see the bottom of the wicks within the same area. Support, support, support. Now this is the same if you go to a larger time frame. Say we go to a 1 day time frame. Right here, what do we have? We have a support level. As you see, the stock bounces right in this level. Right there. Think of this as our springboard. Another support level. Let's find some more. Actually, let's find some resistance levels now. So we see up here, see the stock struggle to break above this area. So we come up, hit it, come back down. Almost hit it, come back down. Hit it, come back down. Hit it, come back down. This is our resistance level. And then because the top of our wicks is hitting this level and getting rejected. And all a rejection means is it struggles to break it. So it's like we're moving up, price doesn't want it, come right back down. So you can use any time frame to find support and resistance. That's the great part about it. You can find support and resistance on a 1 month time frame if you want. You could even use a 5-minute time frame. It's always going to be there no matter what. All right, so now that we have found support and resistance, let's start learning how to use our trend lines. So for this, we're going to look at Tesla. All right, so we're going to go to a 2-day time frame so we can get a better view. So when we're looking at Tesla, our trend line, we're going to use it as a rail to show price moving within one direction, and the bottom being our support and the top being our resistance. So what we're going to do is we're going to take a trend line. We're going to start at an old low, and we're going to line it up with the area where we have multiple bounces. And all I mean by multiple bounces is spots where we have the bottom of our wicks hitting it. So for example, we can see right here, we have it being used as support. And then we see over here, we bounce right off the bottom of that trend line, that support. Right there, right here, right there. So this is going to be our support trend line. So now for our resistance, this can look different on, just based on how you want to look at it. So if we just wanted to look at, everything over here, we could say we have resistance around this level. And we see this because the stock continuously struggles to break above this area. Multiple times we're struggling to break above. Now, if we want to use a trend line to show our resistance, so basically based on this whole thing, what we can do is we can start back here, and you just want to find where it makes the most sense. So where it lines up. So like we could say, let's start right here. Let's see if this looks cleaner. Okay, yeah, right here is perfect. Okay, so you see here how we have our support trend line and our resistance trend line. As price moves up, struggles to break above this trend line. So what can this indicate? Based on this, we can have an assumption, and this is with just the most basic charting, just a trend line. So we could just indicate, okay, the price, gets anywhere within this area near this trend line, we can expect it to move down. And why is that? It's because we have reasoning, because it has happened many times in the past. Here and all right here. So this is key. This is what you want to look for. Yep. So what I'll do after we finish going over this, then we'll dive into the questions. So this is what you want to look for trend lines. So really the trend lines is just to show your overall trend. Let's look at SPY. For that, we see this is where we had that 2020 drop. And then from there, we've been on a move up. So let's take it from like right here. Based on this support trend line, what does it show? Support here, support there, support here. Look, even more recent, support right there. So based on where we had these bounces, this lined up perfectly right here. We bounced right off of it, came back up, went right back down. So now when we're looking at resistance, let's see, let's take our trend line again. Let's see what it looks like if we take it from back here. Okay, so this somewhat lines up. So we have this high up here, and all we did is extend it out to line up with these. And there's really no right or wrong answer. It's if it makes sense to you, it works. Because I can easily put it here. I could just as easily start it from right here and show something like this. all this stuff is subjective. So you just want to find what works best for you. And I'm showing what works for me and how I like to look at things. So there's just a numerous amount of ways you can look at it. So now let's start finding our horizontal support and resistance. Yeah, I'm going to get to the questions later, Nathan. Okay, so for example, let's take that rectangle over here and let's find our horizontal resistance. So we see within this area between 471, 478, we have resistance. And this is because we struggle to break above this area multiple times. So if the price came up here, what can we expect? We can expect to see the same thing. And as it happens, then you want to take a play. So you never want to play something, too early just based on assumption. You want to have reason, conviction enough to actually play something. So for example, let's say, for example, if you wanted to look at a chart pattern, for example, and we'll dive into these later on. I'm just using this as an example. So let's say we have a pennant. Let's just say like this. Okay, let's say we have a pennant and say this pattern is bullish. Ideally, we're expecting it to move to the upside. This could just as easily break down to the downside. So you never want to enter something early, just because, oh, this is a bullish chart pattern. Oh, this is a bearish chart pattern. Just because it is, it doesn't mean that's going to happen. So you always want to wait for a reasoning. And later on throughout this boot camp sessions, we will dive into what to look for when it comes to reasoning and, what that conviction looks like and what the reasoning should be when you're looking to enter a play. So here, you guys spit out a couple stocks, and then what we'll do is we'll go through and find a couple more examples of support and resistance, just so everyone can have a clear understanding of what to look for. All right, so SQ. Let's look at let's look at a larger time frame. So 1 hour. Let's go to 2 hour. Oh, it's still small. Let's go to, okay, so 1 day time frame on SQ. We see the price is just moving lower. As it moves lower, it moves sideways for a bit. And just based on this, we can see we have a level where we have lows within the same area. All right here. Support, 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 support. This is how we identify our support level. Let's find some more. Right here. Just about have the same thing. This level, dipped in, bounced right out, support. Dipped in, bounced right out, support. Right here, same thing. Dipped in, bounced out. Dipped in, bounced out. So this stuff may seem super simple or super easy, but I'm telling you, this is one of the key things that you should understand. So like if you're getting maybe frustrated because it seems like super basic and repetitive, it is, but it's for the best. Just trust me. Let's do one more stock. Yeah, let's do Etsy. They had earnings. All right, so pretty much all right here. This is going to be our support level. Price is bouncing in this area, struggling to break below it. And that's a good thing. Let's see over here. That's the same thing, support, just bouncing right in that area. So you want to find those areas where the price is moving sideways and where it's bouncing. And then you'll find your resistance. So right here is our resistance, struggling to break above that. And then you want to use these two keys to identify if you should take a call or if you should take a put. So yeah, yep, you can use anything to draw your support and resistance. So for example, let's say we want to use a horizontal ray. We can use that instead of using a rectangle. So right here, this shows this line being used as support. Now, the only reason I don't use the line and I use the rectangle is because the line is so precise. So you see how like right here, we're technically not hitting this line exactly, but it's within the same area, so it counts. This is just too precise. So with this rectangle, you'll just highlight the area. So you have more wiggle room. This price always go back inside. Yeah, so eventually the price will form a new trend, but you'll know when it's going to happen based on your support and resistance levels. So think of your support and resistance levels as your key levels. So every time I say key levels, think of support and resistance levels. So the difference of starting your trend line at different spots, it'll just show different things. So like, for example, if we wanted to look at this uptrend, let's say we wanted to start it like right here. So we have the trend starting here, getting rejected, and then we broke out of it. Well, let's say we wanted to take into account all of this stuff. And we started it right here, we could do something like this. So it's just taking into account different things. So now let's go back to the slides and dive into the rest. All right, so when you're looking at charting a stock, the first thing you want to do is identify if it's in an uptrend, a downtrend, if it's moving sideways. You just want to understand the overall picture. So really with this, it'll help you with longer positions. Like if you wanted to swing a position, if you wanted to hold something within a week, a month or whatnot, this will tell you the overall picture. What's happening from the naked eye rather than using our microscope. So the first thing we have is an uptrend. We can tell something is in an uptrend because it's moving to the upper right portion of our computer screen. So just think of it like that. And as the price moves over time, you'll see the lows we are creating is getting higher and higher and higher. Just think of it like stairs. It just keeps going up and up and up. Now, when we're looking at a downtrend, the price is moving to the bottom right portion of our computer. And as the price moves, the lows we create is getting lower, 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 and lower. And the highs we're creating is getting lower as well. So it's just showing the stock is struggling to make newer highs. It's creating lower highs. And lastly, we have a range. So the range is simply all the examples we looked at. And this is just showing our support and resistance level. So this is just showing the stock is moving within this area over a given amount of time. It's moving sideways. It's not, directly moving up. It's not directly moving down. It's moving within a range. So within all of these different trends, so uptrend, downtrend, and a range, you can take advantage of price action in between there. So think of this, this, and this, your view with the naked eye. And then as you look into it on a smaller time frame, then you're going to get more in depth and look at it with a microscope. So when you're looking at trading in a downtrend, uptrend, or a range, then you want to look at all of your different opportunities you have. And here, Nathan, what is your question? I'll just let you type it in the chat. So I've seen you raise your hand quite a few times. So I want to make sure I answer it. Yeah, we can do some more examples. Yep, I'll show you an example of a stock using support levels during the most recent market drop. How many candles can we use? Okay, so what I like to look at is something like technically if it's just one that is resistance or is support, but I like to look for two or more. That's a sweet spot for me. Yep. So this is what the uptrend looks like. The uptrend is moving towards the upper right part of your computer. The downtrend is the bottom right. And as the uptrend is happening, your highs are just getting higher and higher, and your lows are getting higher and higher as well. Yeah, yep. Yeah. So this question says, I know this boot camp is for our own TA, but are we going to cover how to use the information or just info from the plays of the week? Yeah. So at the end of this, you're going to understand how to do everything. So today, at least like for my portion, we're just going over the basics because you can't just jump directly into, okay, like this is how you do this and this and this. You have to break everything step by step. And when you do that, it'll be more efficient. How do you determine what time frame to look at? Okay, yep, we'll go over that. And still waiting on that question, Nathan. So when you have it, just put in the chat and we'll answer it right away. All right, so let's look at the most recent market drop we have. Let's see, for this example, I'm going to look at UPST. Okay, so if we're looking at right here, actually, let's just look at SPY. This will be a lot easier. Okay, so you see, everyone sees how SPY fell down, and we had that big gap down in the middle of this week. Let's see where it gapped down to and where it created that low. So let's go on a 1-day time frame, and let's see where this lines up. So if we just take a horizontal ray, okay, we see, let's look at multiple drops. So all I'm doing is looking at these drops. So for our first example, right here, where that red arrow is, we can see it being used as support. Over here, where we dropped, is the same level. Old support, old support. Let's look at this next line. We dropped here, bounced heavy. This next drop, bounced at that same level. Let's look at this higher one. We have support right here. We dropped, bounced heavy. Over here, we had the same thing. We bounced right on here. So as stocks drop and they rebound, you got to look at your old support levels because that's really going to tell the story. So now when it comes to looking at your uptrend and downtrend and see if it's in a range, I like to use the larger time frames. So like, for example, this 1-day time frame, we see SPY has been on a major uptrend since 2020. And you can see we somewhat been trading within a range. So let's mark that. So I'm not going to try to line these up perfectly. I'm just lining these up just so you guys can see. So let's use our arrow. So here we have our uptrend, and we see how the stock is moving within that channel. Now we can see as that uptrend ended, because we're not still moving directly upwards, we're moving sideways. So we went from trading in an uptrend within or to trading within a range. So just like this. So does everyone see that? We have our uptrend, and then we started trading within a range. And then once our range broke, now we're starting to create somewhat of a downtrend. And how do we know this? Because where's the price going? It's heading towards the bottom right portion of our computer, down here. That's the key. And when you go to identify your range, to answer another question someone had, is basically your support and resistance. So like, for example, the bottom of the range is here. The top of our range, we'll just say like about this area up here. So we're trading within this range. And we can see our old support right there. Here, acted as what? New resistance. So I'm going to give you guys some more info on how stocks move. You're going to have rare instances where it will move directly up like this or directly down like this. But more so, when it moves, it's going to go like this. So as it moves up, it's going to go up, pull back, go up, pull back. And we want to look to get in on that pullback. And we want to play that one move to the upside. And now when we're looking for downside, it's the same thing, but just reversed. So let's take that path again and show how this works. So this is, so like right here, old support, new resistance, one clean move to the downside. Old support, new resistance, one clean move to the downside. So look at this right here. Old support, new resistance. What happened over here? Old support, new resistance, move to the downside. Just like that. Old support. So we got old support here. And then we have new resistance. Just like this. So as you're looking to play things within an uptrend or a downtrend, then you have a numerous amount of different, ways you can play it or opportunities you want to look for. So yeah, this is just showing our trend lines. So now this is where the magic happens, our breakouts and chart patterns. I love to play breakouts. So the idea of a breakout is you have your resistance, you have your support. You're looking to play a strong move out of your resistance for calls or a strong move to the downside for puts. So here you have, so let's just focus on this bottom row. Here you have a falling wedge. This is where price is moving within a downtrend, but it's not an excessive downtrend. It's just, slightly moving down, and you're just looking to play that reversal. Here you have a rising wedge. This is where price is rising, so it's moving up, and you're looking to play the breakdown of it. For a flag, it's somewhat of a consolidation and you're looking just to play the break to the upside. And for a pennant, it's where the price is moving within an area like this, and you're looking to play the breakout to the upside of it. So as you look at these chart patterns, this one is technically bullish, this one is bearish, this one is bullish, this one is bullish. And the reason why I put these quotations is because just because it can be in one of these patterns doesn't mean it's going to work like that. It can easily move the opposite direction. So this is why you really want to identify your support and resistance or your key levels so you can understand, is this looking to break to the upside or to the downside? And as it happens, when should I look to open up position? So yeah, news definitely plays a part of movement. So news is, something that's going to help price get to where it needs to be. So does the new resistance? Yeah. So like if we're looking at the stock moving down and it's just creating lower levels that is struggling to break below, it's showing that downtrend. And then for the next session, what we're going to do is we're going to dive into how to actually draw and look at all these different chart patterns and how to actually take it, into play. So here, this slide shows a list of my favorite stocks to trade / chart. So this is just some homework that I want you guys to work on for the next session. So all of these different stocks, they're tech stocks. A lot of them are large cap stocks. So these are stocks that can actually move a few dollars within a day. So these stocks have a lot of potential and opportunity that you can capitalize on. So here we have Amazon, Lucid, QCOM, UPST, Facebook, NVIDIA, AMD, Target, and Affirm. So what I want you guys to do is just go through these stocks. You don't have to do them all, just maybe a couple, and identify your support and resistance levels on different time frames. So you could start with Amazon, for example. Let's do that. So here we have Amazon. Oops. So if we're looking at Amazon in a 1-day time frame, and we want to identify where we have some support, and if we're looking at the most recent price action, we can see pretty much within this area right here. This is going to be our support area because the price bounces within this area. And we know this because the bottom of our wicks are there. Now let's do another one, another example. If we're looking at, let's say like this price action over here, we have our support level right here. We're looking right here. We got our support level right there. So I just want you guys to go through and practice finding your support and resistance levels, because these are going to be your key levels. And this is what's going to help you get your game to the next level. No pun intended. So now let's find a resistance level right here. See how the stock struggles to break above it multiple times? That's resistance. Here we have another one. Resistance right there. And you just want to go through and practice finding your support and resistance. And once you can do this, like I'm telling you, it's going to be a game changer. You're going to be happy you did it, because you'll start to understand as the price goes to each level, you can expect it to do one of two things. You guys can trade throughout the week if you want to. Some other stocks that I definitely would recommend looking at. Let's see, you have Caterpillar, you have UPS, let's see, you have Coinbase, You have Rivian. I mean, a lot of your large cap tech stocks, those are going to be the ones that move a lot throughout the day. So before we get into tomorrow's agenda, I just want to go through and take a few minutes to answer these questions that you guys have. So if you have any questions, feel free to put them in the chat and I'll go through and start answering all of these. So is there a specific time frame we should practice on? So let's break this down. Okay, so we're gonna create some text right here. All right, so if we're looking to day trade something, so day trade, we're gonna use, so this is from either 8:30 a.m. market open to 3 p.m. market close. So this is a day trade is if you buy and sell something within the same day. So for a day trade, I like to use 15-minute time frame, 30-minute time frame, and the highest I'll use is 1 hour, no higher. Now, if we're looking to scalp something, and this is trades that are much shorter, you're just looking to play one quick move and that's it. I would look at, you got your 3-minute time frame, 5-minute time frame, you got your 15-minute time frame, and I really want to go higher than 15 minutes if I was looking to scalp. And now you have your swing, but within 1 week. So for your swing within 1 week, so this is Monday through Friday, no longer. I would look at 1 hour, 2 hour, and that's about it. I would really want to go any higher than that. So as you're looking at your swing, you want to look at it in the 1 hour to 2 hour time frame. But as you're looking at it day by day, you want to look at your smaller time frames, like your 15-minute, your 30-minute, 45, and whatnot. Now, if we're looking at our swings, but longer than 1 week, now we're going to want to start looking at a 4-hour time frame, 1 day time frame, 2 day, and whatnot. And as the longer swing you want to look at, let's say you're looking at swinging something for 3 years, then you want to look at it's called leap. So just like your long-term trades. Then you want to look at your weekly time frames or your monthly. So this is a breakdown of all the different time frames you want to utilize. So you guys take a quick screenshot or a picture of this if you want information on all the different time frames. And I'll leave this here as we answer more questions. Yeah, I mean, a scalp, you can use, it depends on what type of scalp you want to do. It can be seconds, minutes, whatnot. What to do if you identify support and resistance? Do you wait for confirmation before entering? Yeah, so we'll dive into confirmation tomorrow and later on throughout these sessions. Please display the first slides. Yeah, for sure. Okay, so here's the outline that we just went over. So today we've went over the purpose, resources, criteria, and basic concepts. And then why technical analysis, risk mitigation, identifying entries and exits, using the history to predict the future, and probability. And then here we have trading view. Here we have our criteria. And then we dove into concepts. And now we are where we're at now. Yeah, yep. Identifying entries into exits will be tomorrow. Yeah, supply and demand. You will have access to the recordings. So my favorite types of trades, I personally like playing things within a 1 week time period. So if it's a swing, I'm not going to swing it longer than 1 week. If it's a day trade, then I'm just going to be buying and selling within the same day. I really like to play day trades because I'm looking to play, one strong breakout. So getting in and then getting out the same day and just going on about my business. So yeah, I would say there are definitely certain hours that I don't like to trade. So for example, over the last few weeks, we know the Fed has been coming out to talk a lot. The president has been coming out to talk a lot, and that's where a lot of that volatility comes in. So like around those hours, I don't really like to trade. I really don't like to trade within, really within like the last 30 minutes, the last hour. I personally don't like to trade. I like to do a lot of my trading within the morning time. And that's because that's where you have, a real, whole lot of volatility based on morning movements and momentum. Yeah. Yeah. So we'll dive in later about catching breakouts and fake outs and whatnot. I struggle with support and resistance. Tips or more. Yeah. So what you can do is this is what I want everyone to do. So with these examples that I gave you guys to practice on, you can use other stocks. So what I want you to do is once you start practicing identifying support and resistance, just take a screenshot of it and just send it to me. You can send it to me on Instagram, on Discord. It doesn't really matter. Just, want to make sure that you guys are getting the most out of this because the goal is to make you guys become independent traders. So you don't have to depend on someone else to, chart something for you every single time, but you'll have the resources and the knowledge to go and do it for yourself. And then eventually someone will ask you to chart something for them. Because that's really how it works. Like there were people I used to ask, like, hey, can you chart this for me just to see what it looked like? And then now, like, I do it for other people. So it's like an ongoing cycle. Yeah, I like to study charts over the weekend. And then, when the market opens, then I'll start trading based on that. I wouldn't necessarily say there's a specific plan on TradingView to get. Me, I have the highest one. I think it's called like premium or something, but I got it during a Black Friday deal. I think the most basic one above the free is perfectly fine because all I use it is for the alerts. Yeah. So when a stock gaps up or gaps down, you don't have control over that. But as the market opens, it'll make a move in one direction. And based on that, you'll understand how to play. And we'll dive into that later throughout the next 2 days. Yeah, so there is a pattern day trader rule. This is where you get 3 day trades within a 5 day time period. If you do more than that, then you get restricted for 90 days. It sucks. It's happened to me like quite a few times. So I don't recommend it. You clear your charts of the yeah. So I clear my charts really whenever. I really think it's important to have a clean chart because the more simplistic something is and the easier to view, the better it's going to help you. So stocks that are good for scalping are stocks that, is going to have some movement within it. So like Facebook's a good one. AMD is a good one. NVIDIA is probably the most perfect stock to scalp and day trade. Lucid hasn't moved that much lately. QCOM's another good one, Coinbase, and a lot more. So yeah, there's a bunch of different stocks you can look at when it comes to day trading and scalping and all that. Let's see, 1 second. Got something to pull up. Okay, so for the second, let's see. So for the second day, we're gonna go over, quite a few different things, and it's really gonna be focusing on how to integrate everything we just looked at into us actually playing it. So we're looking at tomorrow. We're gonna go over quick, quick review over identifying trends, and then we're gonna actually start marking up charts from scratch, and we're going to talk through that whole process. So from start to finish, you'll see the whole thought process of what I think about when it comes to charting, and some key things to understand. And then we'll get into the intro to indicators. So indicators, those are just different tools you can utilize to give you more confirmation on stock moving in a certain direction, or just more conviction. So that's the end of everything that I had for this first session today. If you guys enjoyed it, I'd love to hear some feedback. And what you can do is take this survey real quick. It'll only take maybe 1 minute. And then from there, we'll let Nez transition into his portion for tonight. If you guys enjoy this, put a W in the chat. And also remember to send me, send me some stuff. Send me some support and resistance charts so you can get that practice in. And I'm open to helping anyone, any time of the day. All you gotta do is just ask, and I'll be there. Yeah, and there's a lot of different brokerages you can use. I like using Robinhood and Webull. There are different brokerages like TD Ameritrade, Fidelity, and to me, those are really confusing. So I just stick to Robinhood and Webull. But Robinhood is the most simplistic.
All right, that's about good right there.
Wait, one second. Nathan, what was the question you had? So I've seen you didn't ask it.
So I have a question in regards to so I'm going to get this checked out.
Oh, so yeah, we already broke down the time frames. So here, what I'll do is I'll just shoot you a message, Nathan, about the time frames. So yeah, that's everything I had, everyone. Thank you for listening, and also remember that feel free to send me the charts you want me to review.
All right, that's about good then. Seems like I'm up. Today we're gonna cover, actually probably start. Just know that it's a universal webinar, so which means it doesn't only pertain to one group, it pertains to whoever's out there. All right, that's one. Two, you got a problem with anybody such as me or Sire, you come talk to me since we're basically the owners of this webinar. All right. Like I said, I'm a pretty fast talker, so if you have a problem with how fast I talk, you let me know. What else is there? If I'm talking too fast, let me know. Tell me to slow down. All right, that's two. Three, this recording will be posted tonight. For that should be about it. So that should be about it. All right. Take the survey as well, and I guess we are going to go ahead and get started. All right. So go ahead and share my screen. Let me know when y'all can see it and all that kind of stuff. All right. So I'm going to get this thing shut up, pop up. Screen number 2. Yeah. All right. Y'all should be able to see the screen over here, right? Y'all can see all those little tabs, right? If y'all can, great. Now where is my play button? All right, so there we go. Okay, we're still in. So as y'all can basically see, we are basically on day 1. And if you have questions, let me know after each slide is done, and then I'll answer your questions and all that kind of stuff. All right, so that's definitely one given area. We are basically going over market direction. So as y'all basically see, Sire went over trend, okay? Trend and market structure are 2 different things, all right? So if I like to describe it as that trend is more of the sentiment of the market, basically the general principle of the direction of the market. So if you think about it, if we look at SPY, SPY, all right, what's the general principle of the market of SPY is obviously bullish. So think it's like SPY is always going to stay continuously bullish for the next 10 years, all that kind of stuff, you know what I'm saying? Apple, Tesla, things like that. They're all got a sentiment of being bullish all the time. So that's the given concept what we call trend. All right. Now, market structure is the actual anticipation of predicting where the market's going to go, whether it's bullish or bearish. So what I want you to understand is that there are two different things that you're basically going over in that given concept. All right. So that's basically what we, or rather what I am going over in this next given presentation that's coming up. Okay. So with that being said, we are going to go ahead and move on to the objective. So as we can basically see here, the objective for today is basically market direction, market structure, and depth, which is basically swing structure, substructure, minor structure. Let me go ahead and see. So for y'all, I noticed you said that the audio seems distorted or like fishy, whatever. Can you, this sound a lot better, right? I'm sorry. Does this sound better for you right now? Like, is it more louder? Because I'm far away from my mic, that's why. Does that sound better for you? And if it doesn't, leaving the mic and come back in will do a little bit better for you, all that kind of stuff. Yeah, so my mic is over there. I just like to lay in my chair and all that kind of stuff. So, but either way, like I'm basically saying, as y'all can basically see here, we are basically going to go ahead and get started with this. So minor structure, change of character, and in time frame scaling, combining all the time frames in order to formulate a market direction analysis. Okay, so we are going to go ahead and get started on analyzing market direction and the words bullish and bearish structure, or rather all that kind of stuff. So when we are basically going over the concept of bullish market structure and bearish market structure, it's simply better just based on the fact that you are basically paying attention to higher highs and higher lows of the market, or lower lows and lower highs of the market. Okay, so in this given aspect here, you're going to take a look here. And then you're basically going to see how it says a bullish structure, simply put, is the creation of a higher highs and higher lows in the market, or the succession. Okay, so what makes a bullish structure here is the concept of where we have a higher high in the market and a higher low in the market. Okay, when the low takes out that previous high, which means that this previous high that caused a rejection in the market is what takes out, when that low takes out that high, we have a continuous structure. Okay, so as y'all can basically see here is that when price comes here, from that high to this low, and it comes all the way up there, you'll see how that lower on that higher low took out that higher high, which we call a break of structure. Okay, so when we have a break of structure, that basically shows you a continuation in market structure, in other words, in bullish market structure, whereas the bearish market structure is the exact same thing, except now you're going to target the lower low and the lower high. So in this given concept, price will come down, okay? Then you're going to have a lower high, and then price will come down, breaking that structure again, making a new lower low. So basically, this is the concept of basically making things we call significant structure, all right? So what I'm gonna do is go back and go ahead and basically go over significant structure here, okay? So do y'all see how we basically have a higher high in the market? When price makes a high, then rejects, we get a higher low. Okay, so when we get the higher low in the market, and then that low makes a high, and then that low breaks that previous high, this lower higher low here becomes what we call a significant structure in the market. So what is a significant structure? It's based on the fact that if price gets any lower than that low, that's what we call a reversal in the market. In other words, you do not want price to get under that significant structure of the market. Okay, so in this given concept here, what I'm basically saying is that you see how price comes up, comes down, and it comes up again, which means as long as price does not come any lower Yeah, yeah. Here we go. All right, that's about good. Okay, that's my fault. All right, all right. All right, that's my fault. Okay, so I don't know what happened, but we are back, and I apologize. I thought we live in the woods or the middle of nowhere, so there we go. So we are back, and like I said, I apologize. Let me just go ahead and send this link out one more time to anybody who possibly left or whatever. So where is my sending out button? Let me get that thing rolling real quickly. Let me get this thing rolling. Copy link real quick. All righty. Uh, let's see. Who's Ezekiel? Let's get this rolling. Get this rolling. Let's see. Copy link. Put this in. Put this out of everyone. Get this over here. And let's get back into this concept here. You said I sounded so nervous before. Let's go. I guess I was just off that mood, but this sounds a lot better. I sound more energetic now. So let's get started. Okay. So we feel more great. I feel better. Just go ahead and share my screen really quickly. Let me know when y'all can see this second screen, and we will be good to go. So let me know when y'all see it, and I believe that y'all should be able to see just about right now. And okay, now y'all should be able to see that right there. Okay, so where is that little play button that we have in Keynote? So what's going on? I need the Keynote to stop doing that. Okay, good. Looks great. Let me get the chat over here actually, and I need the Keynote on this side because I have multiple screens. So where is my mouse? Okay, so let me just go back really quickly. Here's my mouse. Give me a second. I just need to push this over. I need to put it on this side real quickly. Alrighty, so analyze the market direction, click play. All right, that sounds good. Okay, that should be about good. Okay, there we go. There we go. Yes, I am still recording. Everything's going just as fine, and we should be good to go. So let's go and get this thing rolling. All right. So this is where we're basically getting started. As we can basically see. So like I said, bullish structure. Okay. So so far, do y'all understand what I've been saying so far based off, the things that I've been going over so far, such as like higher highs, higher lows, significant structure, which is where we basically left off, all that kind of stuff. So do y'all understand those concepts so far? Okay, you do? Great, great. So let's go ahead and get started from there, and I will basically continue off from there where I left off. So as you can basically see, we are dealing with significant structure and price action. All right. So yes, we are going to demonstrate significant structure as much as we get further down the PowerPoint, and we will go to the trading view part. So no worries there. And please slow down. I can absolutely do that, as you can basically see. And let's go ahead and annotate this screen and get started here. So back to what I was saying. So higher highs and higher lows. Okay. So as you can basically see, this higher low is basically where we have our first significant structure in the market. Why? Because this is the low that broke the previous high in the market. Now, when price goes higher, as you can basically see, price comes up, it rejects again the market. No biggie. Okay. So when price goes to the higher high than the higher low, you're going to see how that higher low takes out that higher high. All right. So when price takes out that higher high, we're going to have a new significant structure in the market. Why? Because that low took out that high. Now, where I left off here was actually the fact that if you take a look here, you'll see how this low here took out this high, which basically means that if price doing all of this, yada, 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 is going up and down, Yeah. All right. Okay. I don't know what y'all are talking about, but basically everybody seems like they're laughing. Okay. So we are going to go ahead and get started again. And let's hope that I don't disconnect again, but I'm gonna make sure I give Sire some admin access so that way we'll just see whatever goes. So let's go ahead and get it. All right. So let's just see. Yes, hopefully we are back from good. Let's go ahead and see. So how do I give ad? Let me go ahead and find that thing participants I can give Sire. So right here, let me see unmute. Okay, I'm gonna make host real quick. Okay, change the host. Okay, so go ahead and unmute yourself really quickly. And then, okay, he unmuted himself. Now I'm gonna take the host back and then reclaim host. Okay, so let's go ahead and get started again. All right, I'm gonna go ahead and share my screen. Y'all let me know when y'all can see it and we will get started. And let's just hope that we don't get knocked out. All right, so let's go ahead and do that. And let's start rock and rolling. All right, so finger crossing and we're gonna click play and let's get started. All right, so play. Did I ever share my screen? Which screen are we seeing here? Y'all can see my screen, right? No? Oh, there we go. There we go. Share screen. There we go. So we got screen over here. Okay, just click the play button. And we are back in action. All right. So let me go ahead and put this over here. Let's get that rolling. Now, let's, like I said, if it disconnects one more time, no biggie. Like what I'm gonna do is literally record an entire brand new presentation for y'all. So that way y'all have like more than multiple things to look at. So I'll have like another pre-recording and of course this live recording, just in case I do disconnect again. Just that way it's more fluent and straight to the point, all that kind of stuff. Okay. So yeah, that is that. All right. So significant structure. All right. So like I basically said, as we were basically covering, is that we can basically see that we have higher highs and higher lows in the market. So basically, like I said, it doesn't matter how many substructure the market is making. So we are going to cover substructure later. Okay. So as we can basically see here, price is basically, is it raining or anything? So as we can basically see, it says, well, the course, at the end of the day, if it disconnects, I'm not sure your question is really, but I'm gonna go ahead and take a look here. So as you can basically see, this is the significant structure of the market. So as long as price is continuously not breaking this level, like I basically mentioned, then we are overall still bullish. So if it comes all the way down here, like I said, no biggie, because price can literally just reverse and go all the way back up immediately. All right. So the same concept for the bearish market trend. Okay. So the lower low in this given concept here, as you can basically see, is that this will be the low of the market and then the high of the market. So if this lower high breaks the lower low, the lower high will become our significant structure in price action, which means that price should not go any higher than that given area at that moment. So what I mean by at that moment is that as long as price does not make a new lower low, we're good. So I'm going to demonstrate it real quick. So as you can see, price made a lower low, then a lower high, then this lower high breaks that lower low right there. As y'all can basically see, so lower low, lower high, lower low, break a structure. All right. So this becomes what we call a significant structure in price action. Okay. So that is a significant structure in price action. And basically what we want to do is make sure that price does not come any higher than this lower high. So as long as price is still going down or making substructure to the upside, it does not necessarily matter as long as price stays above that high. Okay. So now what I basically mentioned as a new significant structure we made, what I meant by that is that if you take a look here, price creates a lower low, then a lower high. Okay. So when it creates a lower low, then a lower high, the same concept applies. But once this lower high takes out that new lower low, we have a new significant structure in price action. Okay. So basically this becomes a new the new structure in price action, as y'all can basically see here. So if I go ahead and put select, you'll see how I'm going to move this here and put it right down there. So basically what this means here is that as long as price does not go above that lower high, we are still bearish. All right. So is the breakup structure at that exact point? Is the breakup structure at that exact point? Can you get faked out? Is the breakup structure at that exact point? Yes and no. Because I mean, as we get further down the presentation, I'm going to show you the difference between breakup structure and change of character. So basically, yes, you can still get faked out if you're not necessarily taking a look at it, but we got to go over liquidity concepts, which is basically tomorrow, and I'll basically show you how you can prevent getting faked out and all that kind of stuff. All right. So basically, yeah. All right. So let me go ahead and clear all this from the chart, and we are going to go ahead and move on to the next part. But before we move on, do y'all understand that? Any questions so far? Any of that kind of stuff? Like makes perfect sense. All that kind of stuff. You know, saying clear so far. Great, nothing new. This week is all based off structure alone. You know, saying and then I mean I know tomorrow I'm going to teach y'all why news is fake as well. So that way, and why indicators are useless as well. All that kind of stuff. Okay. So yeah. All right, perfect. So let's go ahead and move on to the next slide. Structure alone really takes about 2 hours to teach, but I'm not going to be here for 2 hours. All right. So basically, what we're really going to do is compose it down to at least an hour, hour and a half, all that kind of stuff. But then again, I'm going to do my best to get as much information out as I can as possible. But then again, I talk pretty fast, so I do believe I can get it straight to the point. So as you can basically see, here is a more realistic example of bullish market structure as opposed to bearish market structure. Okay. So as you can basically see here, that if you go to the first part, this is a very textbook example of market structure. So you're going to see always see higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and then higher, you know, same given concept. So every single time a higher low is breaking the previous higher high, it's called the breakup structure. In other words, a new significant structure is being made. So every single time, price should not get any lower than here. But this is not really how structure looks whatsoever. Okay. This down here is a much better example of market structure. Okay. So if you take a look here, because we're also going to get into substructure, minor structure, you're going to see how this price action here, right, is basically a concept of what we call substructure. All right, but we'll cover that in the next slide. So don't get too confused right here. Just focus on the actual significant points and go from there. These significant points are basically highlighted in the little gray, as you can basically see here. So focus on those given points. So as we can basically see, higher high, higher low, a higher high. Now, the actual realistic way of how the chart will look is more like this. So you see basically how this low took out that high. That means this is your significant structure in price action. What that basically tells you is that as long as price does not get this low, you are fine. So the first thing you're going to notice here is how price makes a high, then makes a low, then fails to make a new high. So in other words, you're basically probably thinking here is like, oh, we're now bearish because price failed to make a new high, price came down and then broke that low. And the answer to that is no, we are not. Okay, because what's really going on here is that this is what we call substructure. Substructure is the actual application of what we call swing structure. All right, and then minor structure is the break of a substructure, which is basically the three theory concept of market structure, which we will get over, which we're going to go over in the next part presentation. Okay, so as you can basically see here, price is still going down. Like I said, no biggie, no problem. As long as price does not break that low, there's no issue. All right. So based on what Sire taught y'all so far, you'll be using what we call, you know, things such as like trend line, support and resistance, all that kind of stuff. However, I don't use any of that stuff. I don't use trend lines. I don't use zones, indicators. So I think as I'm trying to see how I'm going to combine his example into this really quickly, since that's technically all y'all technically know so far. So I'm trying to think real quick. So let's hypothetically say that there is a support zone in this given area. All right, so let's say there's a support zone about right here. Okay, then we're basically going to say that price came down here to fill that supporting price action. But because we're still bullish, we should be only looking for buys in that given concept. So when you take a look at the actual significant structures of the market, you'll see that we are still bullish in this given concept. So price is making all of these lower lows and lower highs, lower lows and lower highs. That comes in here's the most significant zone in the market. You'll see how it goes all the way up breaks these substructure zones, switching into minor structure, which we're going to cover in the next slide, then goes up and it comes down excessively again to fill this new area of support level, or rather zone, and then breaks out to the upside, giving you a break of structure. And then, of course, this becomes the new significant low in price action and the new higher high. So when price comes down, you will see how this low takes out that high. And basically, this is a easy concept when avoiding to get faked out and all that kind of given concept. Okay, so I know someone just basically mentioned what time frames were the real time frames examples used on. This can be on any given time frame. Okay, because think is that you're supposed to use every single time frame. And I know Sire basically tells you how to use the 15-minute, but we trade two different ways. I go against everything he does, whereas he goes against everything I do. So the thing is like, he's going to tell you 15-minute, I'm going to tell you the 1 minute. So the thing is that you need to go to the lowest time frame as possible, because the lower time frame build the higher time frames. If you're wasting all your time on the 15-minute time frame, you will miss a lot of moves in that given concept. So basically, stay on the lower time frames, get your buys from the higher time frame, then make your way down to the lower time frames. Okay. So, but then again, there is not only one way to trade. There's plenty of ways to trade. You just got to make sure you become very fluent and good at it. Then you're good off. Okay. So some basic mention, could you label the chart with that vocabulary? Oh, so like I said, substructure will be covered in the next slide, so don't worry about that. And for Apple, you said is the stronger structure on the higher time frame. Yes and no, but the higher time frame will basically show you the overall direction of structure, whereas those lower time frames are used to find your entries and all that kind of sorts. And of course, you're going to need to really understand market structure in order to really actually be able to apply on the lower time frames, because you're going to get very confused if you don't know how to determine substructure versus minor structure and swing structure. Okay, so as we can basically see here, does that make sense for the concept of bullish market structure, real life example, with how I'm using the zones that y'all basically learned from Sire and applying it into market structure concepts in this given area with, of course, breaker structure and all that kind of stuff. First yeses and he knows. So it says, where do you measure the market structure? No, market structure has nothing to do with it has nothing to do with stocks or forex pairs. It's literally just structure alone. So the structure of the given stock. So if you're looking at SPY, what is the structure of SPY? If you're looking at Apple, what is the structure of Apple? If you're looking at Tesla, what is the structure of Tesla? You know what I'm saying? So that's basically the concept we're basically applying here. So this has nothing to do with stocks or options, or it's just the principle of being able to really view how to look at the chart as a whole. Okay, so the thing is, I'm going to tell you all the time is that the chart is its own person. All right, and basically, when you learn to be the composite man or composite man, you are going to see how to really think as one. Okay, so the market, you need to act as one in the market. All right, if you're acting as multiple, you're going to lose a lot. Trust me. So the thing is that you want to focus on multiple stocks, pairs, whatever it is, and then learn its exact movement based off structure alone, and then go from there. Okay, so when you continue to do that, you will improvise a lot and do a lot better in your trading styles. As you can see, basically why Sire tends to trade multiple of the same stocks. Me, I personally just trade those same stocks because I'm lazy. Because I mean, I don't have favorites. I don't have any favorites. I just don't care to send more. I'm just gonna say that, oh, this worked this week, so I'm just gonna keep doing it, and I do it again and again and again and again. You know what I'm saying? So that's just what I do. You know what I'm saying? So is it worth to get the paid trading view version? Depends on you. Depends on your strategy. I'm an institutional trader, so basically I trade with smart money. So the thing is, I need to see every single time frame because I also use the seconds time frame and all that kind of stuff. You know what I'm saying? So now we're gonna go ahead and do is basically go over the downtrend bearish structure of the market. Okay, so as you can basically see, we have a lower low in the market and then lower high in the market. All right. So in this given aspect here, you'll see how this lower high takes out that lower low, giving you a break of structure. And for Chris, I am going to be teaching institutional trading. Basically, that really starts tomorrow because smart money is all based off market structure alone. Without understanding market structure, then you will not be able to really able to use smart money. So the thing is that if your market structure skills are not up par, forget about even understanding institutional trading. Okay, so Sire said it's not needed to buy. The basic version is fine depending on your method. If you're going to trade retail only, you're more than welcome to just stick with the free version. Okay. Now, if you understand the concepts of using institutional trading, trading with the bank, smart money concepts, then you're going to need the paid version, which is like $13.99 a month. All right. And for Diva, you basically mentioned you only get one free alert. That's no problem, because the thing is, like, if you use Stock Alert app or Yahoo Finance, you can set as many alerts as you want, or you can use Webull, all that kind of stuff. So the thing is that depends on how you want to like make alternatives and all that kind of stuff. Okay, so as I'm basically saying, with the downtrend bearish market structure, we had a lower low, then a lower high. All right, so with that lower low and then a lower high, you can see how price comes down and makes a lower low at the market. So when price makes a new lower low, we call that previous area of breaker structure. In other words, that lower high is our significant structure in the market. So with that significant structure in the market, what that's telling us is that that new high that gets formed cannot go any higher than that previous lower high. As long as we stay under that lower high, we are going to stay bearish in that given aspect. Okay, so basically, we take a look here, like I basically said, this lower high is in this area. So price comes up here and does all this, like all this kind of stuff, like no biggie. Then as long as it stays under, we are bearish. So basically, you can see here, price goes under, and then basically we make a new lower low. In other words, we have a new significant structure, this given aspect here. So you can see, once this lower high takes out this low, giving us a break of structure, this becomes a new significant structure. All right. So what that means is that this low cannot come higher than this high. Now, I don't mean this high. I don't mean this here. I mean this high right there, because this high took out that low. All right. So like I said, again, this has nothing to do with timeframes. This is just a general concept of understanding structure alone, because all this principle here applies to every single time frame that you're looking. Now, when we go to time frame scaling, when we go to tradingview.com, I'll show you how you navigate and build an analysis based off using the higher time frames and then working your way down to the lower time frames. Okay, because your higher time frame might be bullish, whereas your lower time frame might be bearish. And the thing is, like, you have to learn how to take advantage of taking the bullish way before going, taking the bearish before going bullish. All right. Because normally, like I said, the lower time frame build the higher time frame. And of course, using supply and demand zones, which we cover in day 3. All right. So how long did it take me to get a gist of this? I learned it all in a month. But the thing is, how did I get fluent? In about a year. So the thing is, I kind of got it down all in a month, and then the rest was all about experience. So the thing is, but then again, I was in college, all that kind of stuff. So I just stopped going to class, stuff like that. I started studying like 12 hours a day. So here I am now. But as you can basically say, so you can see how that lower low is created. It makes a lower high, then goes down. All right, same concept. Now, we are going to go to the real life example here. So with the real life example, what we can see here is that price basically makes a lower low, then a lower high, then gets your break of structure, meaning that this is the significant high in the market. So when you see price come up, you can see how it makes a higher high, higher low, higher high, higher low, higher high. All this is what we call invalid market structure, because none of this structure is true structure, because your high of the market is here and your low of the market is here. Okay. So when you understand those two areas, you'll basically be able to see why price is doing what it's doing in that given concept. So then you see how this high comes down to take out this low. But in reality here, what's really going to happen is that this is the high, that took out the low. So this truly will be your more significant structure in price action. So in this given textbook formation, I'm not really sure why this is the lower high. It's really supposed to be this one, but that's the actual high of the market. So I understand why it's placed there. So no biggie. But in reality, you want to go for the high that takes out the low, or the low that takes out the high. So in this given concept, this is the high that takes out the low. In other words, this is your new significant structure of price action. So price comes down and of course creates what we call new structure right there. Then a new lower high, price goes down, giving you a break of structure. And it basically, that's your new significant structure. So does that make sense? That kind of thing. Does that make sense so far? Yes, great. Any questions so far? I'm really just looking for questions, all that kind of stuff like that. Great, great. It says, can you say again? Can you say again why the other one did not count? So this one, in my personal opinion, does not count because of the fact that, like I said, we're still gonna go to trading view, by the way. We're still gonna go to trading view, so don't worry about the line chart. But basically, if you take a look here, this lower high only broke this structure to the downside, but this low is not significant at all, okay? But if you take a look here, this high takes out this significant low. In other words, this becomes the new significant structure in price action. Does that make sense for Myra? And then for call, so do you use the lower high as the max resistance within all structure? The answer to that is no, I don't use support resistance at all. Vanessa, what do you mean by new zone? So what do you mean by new zone? Like I said, zones, take it out the picture for now. Like this is just focus on the concept of structure, okay? Because the concept of structure here has nothing to do with zones yet. When I get to the trading view concept, I will show you how you apply the zones with market structure, since that's what Sire taught y'all so far. But on day 3, you are going to see how I don't use any of that stuff. So I'm going to basically be going over what Sire taught y'all. Then day 3, I'm going to go do the opposite of everything he does. Okay. So basically, yeah, that is that. All right, so let me go ahead and delete this and let's get started on the next slide. As we can basically see here. So this is slide number 5. So here is the actual principle of basically where we're going over substructure, minor structure, and all that kind of stuff. So this one's the more complicated version of overall structure. So if I go back, okay, let's just say I go back here and where is the back button anyways? Work? Nope, okay. It doesn't work either. Okay, so we're not gonna go back then. I don't know how to go back. So as I'm basically saying, if you take a look here, we're going to go ahead and get started on this one. So where is the draw? Oh, okay, there it is. Yes, there we go. So like I said, if you take a look here, this is only one direction in the market, okay? But if you take a look here, this one gives you multiple directions. But the thing is, I'm going to show you how they're all in valid structure where I should be focusing on certain concepts, okay? So let's take a good look here. Not draw, but this. So if you take a good look here, you're going to see how price has a swing structure. So the blue is the swing, okay? Which means that, let's just say we're on the 4-hour maybe. So blue will show you the 4-hour concepts. Whereas, you know what? Let me change my color to this and make this blue. So here, this is the 4-hour. All right. Anything that's red will be, let's just say the 30-minute time frame. Okay. So the blue is the 4-hour, and anything that's red is like the 30-minute time frame. So on the 30-minute time frame, you're going to see how price becomes bearish. All right. And there's one thing that I forgot to add in. Price action will always look to create healthy price action. So if you see a huge impulse in price action, that's what we consider unhealthy price action, which means more than likely price is going to come back down and retrace back down into the market. So basically you can see how price is retracing back down in a healthy manner instead of excessively going all the way down. You'll see all that healthy price action to the downside. And when that happens, you'll basically see how price is creating, restoring health, or rather restoring, like, how do I say it? Let's just say restoring health back into the market, okay? Because the price keeps going up, it's an unhealthy market in that given aspect, all right? So that is definitely one thing they want to pay attention to when you're using structure and all that kind of stuff. So the red is the 30-minute time frame. So in this given concept here, you'll take a look here, and then you'll see how price is creating what we call substructure. So substructure is the concept of using retracements in price action. So what's retracement? Is basically just where price goes up, then comes down before going back up. Okay, so basically, if you see something like this, let's just say this is the 4-hour time frame. This red is the 4-hour time frame right here, and then anything that's occurring inside this given area, you'll basically see how this here replicates what's going on here. All right, so this retracement here is basically what we call a substructure. Now, if you take a look at down here, substructure. All right, basically it breaks no structure to the left. So as you can see here, all this, the low of the market is right there, and this the high. So you see all these little price action that it's making, it never breaks any type of structure to the downside on the left of the market, okay, in this given picture. All right. Now, the moment price comes up, you're going to see, I'm going to make this pink for a certain reason to show how it's minor structure. So if you come up here, oops, that's the wrong one. So if you come up here, you're going to see how price does this. And then you're going to see how this high took out this low, showing you a continuation in substructure break of structure. Okay, so basically that substructure broke this structure to the downside. And in base, when price comes down, then goes higher, we have a new break of structure to the upside. In other words, we call this a minor break of structure. And then when you get a secondary break of structure, we call this a new substructure in price action to the upside after the reversal. So this is where, you know, the complication go rather than, yeah, it's going to start getting a little more complicated. And I'm going to tell you this right now. It took me about 6 months to really get down market structure. So I'm going to tell you that right now. I'm going to be honest with you. It took me a long, long time to understand market structure. But then again, I couldn't get anybody who can really make me click it to me because, like I said, I don't watch YouTube, any of that kind of stuff. And most people who taught me were just kind of, you know what I'm saying? So I had to find a way to get it down, and I did eventually. And then, so that's what I'm replicating right now, all that kind of stuff. So this is what we call the three theory of market structure. And yes, this could be analyzed on any given stock. It doesn't matter what kind of stock it is. It doesn't matter what Forex pair, it doesn't matter what crypto. Market structure will tell you exactly where price is going, as long as you're able to identify market structure correctly. Now, you are going to have to equip liquidity concepts with using market structure, which we're going over tomorrow. Okay, so once you understand these concepts, this has nothing to do with chart patterns at all. So chart patterns, throw it out to the window. Zones, throw it out to the window. Everything, throw it out to the window. Market structure is market structure alone. Don't try to overcomplicate it with everything that you learned with Sire or anything that you saw on YouTube. Just keep structure with structure. It's just going to tell you that direction of the market, and that is it. All right. And that's what I want you to keep this simple. We're not trying to put things together here. We're trying to keep everything really separate right now. Now, when we go to trading view, we can combine whatever we know. But right now, I want y'all to see how the market moves, how to identify substructure, minor structure, and, you know, continuation in structure and overall swing structure. Okay, so everything else, throw it out the window for now. In the meantime, okay. So that is one thing that we're definitely looking at as we're basically speaking and going from there. All right. So as you basically see, then again, also this whole entire concept here can basically be a whole entire minor structure. It doesn't really matter, but I like to say minor structure is the first concept that breaks that substructure in price action. Then price breaks the new high that was created in the market, and it comes over here and gives you a new break of structure. We switch that back into substructure because all of this in here is basically still substructure, because the thing is that we're still sitting under this high. So this whole entire area is what I call invalid market structure. Now, I'm not saying it's not valid. Okay, I'm just basically saying that you don't have to consider this bullish or bearish, because the thing is that price is still bullish in the market. All this right here is just what we call noise. In other words, significant structure is this low and this high. But you can definitely buy and sell in the market in this given area if you really know what you're doing and you know how to identify using substructure and minor structure in that given concept. Okay, so as long as you know how to do that, you are going to be good to go. Okay, so as we can basically see here, we are going to go ahead and I'm going to pinpoint one more thing. So if we're using zones or whatever, we're just going to pretend there's a hypothetical support down there. So basically, when price comes down here, you'll see how price comes up, gives you a break above, because there might be some type of demand. No, I'm sorry, not demand from my head. Yes, demand. All right. So there might be some type of demand down there, and we are going to go over demands on Sunday. All right, supply and demand zones, because I need to clarify order blocks, all that kind of stuff on Sunday as well. But I got to make sure I understand liquidity and market structure first. Okay, so that is that. So hypothetical zone is down there, right here. Hypothetical support. So when price hits that hypothetical support, you're gonna basically be expecting price to break this high and then switch into minor structure, which will show you that price is basically ready to go. Now, you're gonna play it safe, and you don't want to be risky in the market, so you want to get faked out. No biggie. You can wait for price to basically break that previous high in the market and create a minor structure, and then wait for a retest in the market. So if you take a look here, you can just wait for some type of retest in the market here. So let's just say there's another hypothetical support down there. Then when you find that zone in the market, you'll basically place it there, and then price goes up, breaking that substructure again, and as you basically see, now you're in the trade for the long term because it's showing you continuation to the upside. So as y'all can basically see, price comes up here, does the same thing again, can use some type of structure right there. As you can basically see, hypothetical zone to the upside, and when this, you're gonna see how this high, or rather this low, takes out this overall swing structure, giving you a break of structure to the upside. And of course, this becomes our new significant structure on the lower time frames. Now, if we're talking about the higher time frames, and I bring this back with the blue indication, you'll basically see how this is a swing output. Okay, so on the swing output, that's how it should really look. All right, now in the minor output, meaning the pink, you'll basically see when price gets all the way up here, the moment it breaks this low, our lower time frames is now bearish. Okay, and then basically it's because we need to create healthy price action. Okay, so then again, so what exactly counts as confirming a retest? Waiting for a full candle close on the other side. So you see, so the questions y'all are asking right now have nothing to do with market structure. So the thing is that I haven't taught y'all how to enter based off market structure. Save that for later. You know, so we're gonna get there. Don't overcomplicate yourself. Just keep watching, all that kind of stuff. You know what I'm saying? So it says this seems like strategy is different than what you're explaining for structure. Yeah, you're gonna see. So give me a second. It says how long did it take to get that faster charting? A month to understand it, a year to really get it done. Where would you enter the trade? Like I said, we're going to cover that in the next given slides, all that kind of stuff, and then all that kind of stuff. So can you clarify on what you said about the lower time frame being bearish towards the end? So what I basically said is that if you take a look here, let me go ahead and clear all this up really quickly. If you take a look here, you're going to see how this pink is the lower time frame. All right, the pink is the lower time frame in price action, right? Whereas these blue indications are bullish structure in price action. Okay, so when you get this indication here, you'll see that how this low is the lower time frame low of the market. So when the market comes down, this is going to mean that the lower time frame is bearish. However, based off the blue highlighters, we are still bullish. Because we take a look here, price has not came under this low. So now do you see how I'm basically combining using the lower time frames with the higher time frames in this line chart in that given aspect? You know what I'm saying? It says, but how are you adding the time frames? All this is hypotheticals. You know what I'm saying? All this are hypotheticals. You know what I'm saying? So the thing is, like I said, when we get to training view, that's where you see the actual concept. These are just the concept principles. You know what I'm saying? Then again, when it comes to entering, this has nothing to do with entering. This is all based off viewing market direction, knowing where the market's going to go next. Okay, so when we get to the next slides, I think slide 7 or 8 will start showing you more about potential entries and all that kind of stuff. Okay, so like I said, it's all there. Just let me get there first, you know, and we'll get rolling. All right, so let's go ahead and continue on there. So the fourth would be the lower low. Wait, what? The lower high. So the fourth would be the lower high. 1, 2, 3, 4. The fourth, 1, 2, 3, 4. Which fourth one? Yes, so the higher time frames would be the blue dots. That is correct. Blue indicates higher time frames, such as the 4-hour, such as I quote, such as hypothetically speaking. And then the pink indicates lower time frames in that given concept. All right. So blue 4th dot. So 1, 2, 3, 4. So in that given concept, that's a lower low, or rather, that's a lower low in price action. I'm sorry, a lower high in price, or rather higher low in price action. So take a look here. That's a higher low. So rather higher high, higher low, higher high, higher low, and higher high. Makes sense in that given aspect. Let's see. Let me make sure annotations off for others because okay. Yeah, so let me go ahead and make sure that I can turn on this thing. So let me make sure it's just disable annotation for others. Okay, so do you start your analysis with the lower time frames? No, start with the higher time frames. All right, so what would the last blue dot represent? Just continuation of price action. Basically, we're fully bearish at that point. Because once you broke that significant structure, at that point, you're basically bearish. And we were just expecting rejection to the upside and all that kind of stuff. All right. So that is that in that given aspect. So now we are going to go ahead and go over change of character. So change of character is really the principle of using the first break of structure that occurs in the market. So if you take a look here, as we can basically see here, is that let's go here and we're going to click this. All right. We have price make a higher high, then a higher low, then a higher high, then a higher low, then a higher high. Natalie, I think you asked me this question like 3 times, but like I said, this concept part doesn't teach you how to buy or sell or where you're going to buy or sell. That's all based off using your zones and all that kind of stuff. So as I basically said, try to leave that question to the side for now because I'm not going over where's the best time to buy or sell. Like you need to focus on the bigger picture of how to identify where the market is going in the first place. If you don't know where the market is going, you're not going to know whether to buy or sell in this given aspect. Okay, so as we're basically looking here, what I'm basically saying is that we have a continuation, so higher high, then price comes down here, does not make a low, but it comes up here and makes fails to make a high. All right, now when price makes a high, if price breaks this low, that does not mean you're bearish yet until it breaks that significant structure. So all these significant points in the market right now are highlighted in the green dots, or rather the green highlighters. So if you take a look here, significant, 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 and so forth. All right. So basically in this given concept, this is basically where you can see all the significant structure in price action. Going here, going there, going here, and going there. Okay. All that kind of stuff. So, but the moment price breaks this low, that's not an issue. All right. That's no biggie. Now, but the moment price breaks this low, which is significant in structure, this is where we will get our first, what we call change of character. So what is a change of character? Change of character shows your first potential of a reversal. All right. So let me take a quick break here. So instead, so the one underlined in the blue is considered minor movement. There is no minor structure movements here. There's some structure movement, but there's no minor structure movements. Because this is what this for minor structure, this is, let me take a look here. Let me take that out. So this is what minor structure applies to. So if we take a look here, price makes a lower low, a lower high, a lower low, a lower high, then a lower low, right? And let's say price is ultimately bullish. So price came up and then made lower lows and lower highs, right? So in this given aspect, do you see how this high took out this low? So in this given aspect, when price comes up here and take out that high, that break of structure is what we call a minor break of structure because we broke the structure inside the substructure in that given aspect. So that's where you will find your minor structure from. But in this given concept here, there is no minor structure. We do have substructures, however, it barely lasted. So the substructure occurred from here to there. That's it. All right, that's all it was. But then you see price was still going all the way down. And instead, it broke this low, giving you what we call a change of character. And basically, this high of the market is what really actually broke that low. In other words, this is the actual significant point of the market. So as you can basically see here, what this chart is basically really showing you is the highs and the lows of the market, but disregard that. Okay, I want you to really disregard that because what I want you to focus on is using the structural points that broke the lows or the highs of the market. So what I basically mean by that is if you take a look here, you're gonna see how this high took out this low. In other words, this here is an actual significant structure of the market in that given aspect. Okay, so basically when price comes over here, it's going to come to the supply zone and then sell off from there because this is the actual structural area that broke structure in that given aspect. So basically, yes, so did not break the previous high, there's no need for this area to be considered the significant structure market in that given aspect. Yeah, so that is the in that given aspect. So basically, change of character only occurs once in the market, and it basically shows you your first sign of a reversal. Okay, your very first sign of reversal is basically going to be a change of character. All right, and then going from there or whatever, all that kind of stuff, so just, it says, me again. So 4 hour, someone asked a question, they said 4 hour equals structure, 1 hour equals substructure, 15 and 30 minute equals minor. That is incorrect. I was just showing you hypothetical situations. All right, for Nico, for your question, what's the direct message? But for your question, all this is hypothetical speaking. So the thing is that market structure has nothing to do with timeframes. Market structure has nothing to do with, so just because you're in the 4 hour does not mean you're a full swing structure, or if you're in 1 hour substructure, that kind of stuff. The thing is that if you go from the daily to the monthly, then now that 4 hour is technically minor. So the thing is like, no, for your question, no, the answer is no to that. All right, they're all relative correct. Yes, they all do the same thing. It's just that it depends on the time frame and your given concept. But then again, it's gonna make more sense when I actually go to the chart. But as of right now, we're just going through the PowerPoints. So that way you can understand the concepts before we move into the actual concept. I'm sorry, the actual principle, meaning like the actual charts. Because when you go from the concept to the chart now, it's just like two entirely different things. All right. So I'm gonna tell you that right now. So, and of course, when you go to chart it yourself, like I said, again, two different things. It seems easy right now. It may not. But then again, when it's time to do it yourself, you're gonna get slapped in the face. You know what I'm saying? It's gonna happen. All right. I know someone asked me a question here. So someone asked me, would you recommend any good books? The answer is no, I do not read books on trading. I think that's just so silly. For me personally, I don't read books on trading because the thing is I need to see it, not read it. So my thing is that I chart instead. I don't waste my time reading the books on trading, all that kind of stuff, you know what I'm saying? There's a lot of books out there, but I'm not gonna ever recommend a book to anybody for trading because why am I gonna tell you to read a book when this stuff move? You know what I'm saying? Am I gonna tell you to go read a book on how to get faster when you should just go run? You know, so of course you can learn little bit things about like maybe this and this and this. My thing is, you know what I'm saying? If you want to go get faster, and I'm gonna tell you, yeah, read a book on how to get faster, you ain't gonna get faster. You know what I'm saying? So what would you recommend to continue to develop understanding market structure? Experience. Doing it again and again and again and again and again. You know what I'm saying? So depending on the type of trader you're willing to determine the structure. No, incorrect. So for Nico, for your question, let me see how to put it this way. Depending on the type of trader, it just has nothing to do with the type of trader you are. It's just a concept of, so what I want you to understand is that I know you're confused, okay? Minor structure and substructure are the same thing as swing structure. So if you take a look here, all this right here is swing points, all right? But the moment price fails to make a new high, you're going to have substructure in there, all right? So anything that's going on in that given area, well, I mean, I want it, but you want to come here. I'll get it later. I'll get it later. No, I'll get it. I don't want to stand up, so I'll get it there. No, you good. Don't put it in boxes. No, you're fine. No, you don't. It's okay. All right, so as you can basically see here, so basically, as you can basically see, so like I said, minor structure and substructure have to do with the concept of what's occurring inside that swing structure. Okay, so it has nothing to do with it. They're not separate from each other. But I think it's gonna make more sense when I get to the actual trading view. So if you're still confused, just keep asking questions and we'll go from there, okay? And where did I learn all these concepts? Self-taught, and if you want to spend $2,000 on a course, be my guest. Their name is WWA Trading. So if you want to spend $2,000 on a course, you can go ahead and join. But I think that to select you anyway. So not to sound down or anything. You have to prove that you can trade to them. And if you can't trade, they're not taking you in. You know what I'm saying? So yeah. So that's another thing because I learned from Marine. You know what I'm saying? So yeah. Yeah. So anyways, yeah, let's clear this chart. And so should I go ahead and move on? Any questions so far? Can I go move on? Yeah, no, yeah, no, anything? Yeah, yes. Any no's? So minor structures within the sub and sub is within structure, correct? That is correct. Much better, that's correct, yes, yes. Okay, so it says, what does supply and demand zones mean? Don't worry about them right now. We are going to cover them on Sunday, all right? So I don't want to throw you off or anything, just don't worry about it as of right now. On Sunday, we will get the actual understanding of what supply and demand zones mean. But in hypothetical situation, they are simply support and resistance zones or order blocks in price action. Now, what is order blocks? Forget it. We're gonna learn that on Sunday too. Okay. So try to ignore it for now. There's gonna be certain terms that I use, all that kind of stuff, you know what I'm saying? So is there a difference between break of structure and change of character? It's the same thing, but change of character means the first reversal in price action. So if you take a look here, let me go ahead and use the line chart. If you take a look here, this break of structure, this break of structure, and of course not a break. But the thing is that the first reversal to the downside is what we call a change of character. And then when continuation occurs, that's what we call a break of structure again. So the moment price does this, break of structure again. Now, the moment price comes up, change of character, and a continuation, break of structure. And the price goes down again, change of character, and then continuation, all that kind of stuff. Price comes up again, change of character, same stuff. You know what I'm saying? So all that kind of given area. Perfect. All right. All right. So let's go ahead and move on to slide number 8. And then someone asks, how does aspect structure correlate with impulsive retracement movements? They don't. I mean, they do, but they don't. But the thing is, like, let me go back to this question really quickly. You have a lot of questions. You have a lot of questions. That's no problem. You have a lot of questions. But how do I put it? How does it correlate with impulsive and retracement movements? So impulse movements like this will have a strong move to the downside. And when price is doing something like this is what we call substructure. Like that slow movement back up is what we call substructure. But once you get that first break of structure to the downside, in other words, change of character, that's where your minor break of structure comes in. Make sense? Yeah, no, yeah, no. Yeah, perfect. All right, so now let's go ahead and move on to the next slide. So break of structure versus change of character, or understanding, what is that noise? Or understanding change of trend. All right. So in the next slide, we're gonna go ahead and like I said, in the next slide, we're gonna go into actual tradingview.com, and then we're gonna do a questions game. So I'm gonna expect y'all to answer the principles of what I'm looking at here, how to identify break of structures, all that kind of stuff. Okay. So as we can basically see here, this is based the concept of break of structure versus change of character. All right. So with that being said here, we can basically see how in this given concept here, let me go ahead and click. Yeah, this right here. So in this given concept here, we can basically see how we have a higher high, and that's a break of structure because this low took out that high. The price comes down again, goes back up, break of structure. All right. But in the actual standard bullish market structure, this is what we're going to actually see is that price goes up, have a higher low, a higher high, a higher low, then a higher high, then a higher low, then a higher high. The moment price reverses to the downside and breaks that significant structure in price action, you're going to call that what we call a change of character. So this shows you your first potential reversal in price action. You're gonna get the PDFs, you're gonna get the recordings, they'll all be in the Discord, all that kind of stuff. You know what I'm saying? So as we can basically see, if we take a look at what this thing says, price creates a lower low instead of the expected higher low. So the change of character has begun within the market from change from bullish to bearish. In other words, a change of character basically means when you're making a change from bullish to bearish or bearish to bullish. In other words, change of character, understanding change of trend. Okay. And as y'all can basically see, we're now in a lower low, then a lower high, then a lower low. In other words, break of structure. And then of course, the same concept here, like we said, we basically cover this area. It's gonna be the same exact thing here. And of course, I think Sire demonstrated charts to y'all. So now I'm gonna go ahead and show you the example of using a chart. So let's just say that we're using a trendline concept. If you can see a bearish slope or a downward slope, you know what I'm saying? Nico said we have lifetime. Yeah, you have lifetime examples to this. Mine is only generalized. Sire's might be the full example of everything you learn. Institutional trading is very detailed. So I'm really just teaching the detail aspect of it. So it gets a lot deeper than this, it gets worse than this. So yeah, just understand that, all that kind of stuff. So what does the change of structure mean? There's no such thing of what? What does a change of structure mean to a trend? Nothing. Like that all depends on a higher time frame. So it means absolutely nothing. It depends on a higher time frame, all that kind of stuff. You know what I'm saying? So as we can basically see here, so when does that first higher low get created? Does that confirm? So when that first higher low gets created, with that first higher low, you mean lower low or higher low, lower high, okay? So when that first lower high gets created, which means this one here. So we're taking a look here. This is a lower high. And you can basically see how, or do you mean down here or up here? Which one do you mean? The bottom or top, bottom or top, bottom or top? This the bottom, this the top, the bottom, the top. Okay, so up, okay. So basically when this lower high gets created and breaks this lower low, that's a break of structure. That shows continuation because we had to change a character in the past that showed you your first potential reversal. So price rejecting this area just means that price is possibly rejecting, but when you break that low, that shows you continuation in market structure. Okay, so now when we went to the bottom area, since Sire basically demonstrated since Sire basically demonstrated charts to y'all, this is called a channel. So in this given aspect, now you're gonna ask yourself, how do you know when to use charts? How do you know when to enter? Let me go ahead and show you the perfect example here. So if you take a look here, you're going to see how this is a great example of using a breakout example. So if you take a look here, if you understand how to apply market structure with your chart patterns, you don't enter market structure. I'm sorry, you don't enter these chart patterns until the breakout occurs, right? Now, let's say you want to be more safer. No biggie. You can use what we call the retest concept. So basically, when price comes here, making lower low, lower high, lower low, lower high, lower low, you're going to see how price breaks out of the chart pattern, giving you a change of character, basically means a risk entry. And then when price comes down, retesting on this trend line or hypothetical zone that's given in the area, you'll basically see how price has this given aspect here. And then price comes up, rejects on that hypothetical zone, and then goes up from there. In other words, now we have a break of structure to the upside, showing you continuation in price action. So you will keep holding this trade until price breaks a low. The moment it gives you a change of character, you get out the trade. In other words, if you're using plays of the week or you're a solo trader or whoever you are out there, that's basically what you're gonna get this given aspect that you can basically see. So makes sense. Makes sense. Because this is the last slide. All right. And we're finally gonna move on to trading view. I know, finally. Yeah, I know it's been some time on the, all that kind of stuff like that. So no questions so far. So we'll go ahead and go to the next part. Okay. So when you get a change of character, you get out. In terms of when you're swinging position, yes. When you're swinging position, yes. All right. So is your rule of thumb when there's a change of character, get out of trade? No. You know what I'm saying? It's not actually, so you're going to learn that on day 3. You're going to actually see my rules on day 3. As of right now, the basics of market structure is applied that when you see the first change of character, you get out the trade. But in my rule book, the answer is no. Okay. Because the thing is that I don't really use change of characters. I use liquidity concepts. All right. So does retest happen very often? I don't know. I don't use support or resistance. I mean, I can give you an answer, but the thing is, they're going to tell you how it's 50-50. But in reality, it's not about happening. It's about where price rejects. Price will always retest. The question is where. So the thing is, if you're waiting for price to always break out in one of these given areas, you'll just miss the trade. Because personally, when I tell people they're using chart patterns, forget about the retest. Just use the breakout and enter at the breakout. Because you wait for a retest, price will just keep running up. You know what I'm saying? So that's definitely one thing that I want you to understand when using that given concept. All right. So that is that. All right. So as we can basically see, next we'll go over how to correctly identify these on live example charts. And we're going to play a questions game. And then I'll be open to questions. And someone said, what time do you set trend lines on? I do not use trend lines. Are you an institutional day trader or swinger? I am both. Depends on the given aspect. But like I said, I trade with prop firms, so I don't use my own money. I trade with like $600, $600K accounts, all that kind of stuff. I mean, well, the account I trade was like actually $400K. So I trade with like about $400,000 in my trading account. every single time. So the thing is like, in that given aspect, there's no need for me to swing any trades, you know what I'm saying? So I just go for ratios. So as long as my ratio is above 1 to 5, I'm green. You know what I'm saying? So that is that. So it says, will you go over? No. So yeah, question game, all that kind of stuff. You know what I'm saying? And of course, as you basically see here, tomorrow's day 2. Disregard this was like the old thing. Don't worry about this. Like this doesn't matter. You know what I'm saying? Just this will be in the Discord. Okay. So join the Discord. It's in your emails. If you're on the Discord, it's in your emails, all that kind of stuff. So tomorrow we're gonna cover why is news fake? Is price control? Can we predict the market? The answer is yes. What is the difference between recharge schematics, institutional? That's supposed to be retail schematics versus institutional schematics. How do they vastly differ? Liquidity concepts, structural, equal, external, and internal. Okay, so basically, when we go over liquidity concepts, you'll basically see how all that stuff kind of go from there and all that kind of stuff. You know what I'm saying? For sellers global, yes, I actually only trade forex. I don't even trade options at all. I don't care for options. I don't like options actually. You know, so I hate options with a passion. You know what I'm saying? The Discord is working. I just have to make sure I manually add y'all. So the thing is double check again. But things when I get out of here, then I'll go ahead and manually add anybody who joined late. So if you joined late, then I have to add y'all in, all that kind of stuff. So like I said, we're gonna cover that tomorrow, and then we will go from there. Yeah. So let me go ahead and clear this out, and then let me stop sharing my screen really quickly, and let me pop up the trading view. Okay. So I'm gonna go ahead and pop up the trading view, and we will get started from there. All right. So just go ahead and kind of navigate all this kind of stuff. You know what I'm saying? So yeah. So let me minimize this. Let's put this over here. Let's put this over here. All right, let me know when y'all see my screen. Share screen. And desktop number 1. And yeah, great. All right, let's get started. Sorry, I mean, this is a trade from earlier today. Let me just kind of see what we can do. So I think we should start off with the concept of time frame scaling. Do I teach forex trading? I do. I have a course. So yeah, but yeah. Let me see. I'm trying to see something that's been marked up. Okay, so I've been marked up. Well, I'm going to show y'all stocks, and but I'm going to show you the forex pairs because they're more clean. They're cleaner. There's no gaps, all that kind of stuff. So I just want to show you like a very clean, concise chart, all that kind of stuff. All right. So as we can basically see, we're going to go to the 4-hour time frame, and with this 4-hour time frame, I'm going to kind of get this out of the way and do this. Let me just kind of check something, show you very general examples. To see how to identify structure in the market. All right. I think we're going to use this area. How far back is this? August 21st. That's too far back. Use USTJ. Alrighty. Yeah, I think we can play around this area. All that kind of stuff like that. I'm not even marking up anything. I'm back testing, not marking it up. All that kind of stuff. You know what I'm saying? So we're gonna go ahead and use this as an example. Yeah, it's perfect. So we're gonna use this area as an example, all right? So based off time frame scaling, what we're gonna do here is we're gonna zoom in. All right. So when we zoom in, you're gonna see the chart. And so this is a more realistic view. I'm gonna change my colors actually to make it more user-friendly because red means down, green means up. All right. So if you take a look here, well, first thing first, if you feel confused about market structure, all you can really just do is go to what we call candles, click line, and then you're going to be able to get all of this. So the only issue is that there's a lot of lines here, but you can still see significant structure in price action. So take a look here. Lower low, lower high, lower low. All this is noise. This high takes out that low, significant structure. So price, lower low, lower high. And then, well, if you go to the actual candles, you're gonna notice that that's really nothing there. You know what I'm saying? So in reality, that's your high of the market. Okay, so that's your high of the market right there. Price makes a low, then makes a high, then makes a low, and then this high takes up the low, all that kind of stuff, you know what I'm saying? Stuff like that. So that's if you're confused about identifying structure. Now, I don't want you to practice on the line chart at all, you know what I'm saying? Because I want you to actually practice on actually being able to view the chart from the given aspect using the candlesticks, because that's what matters the most, stuff like that, you know what I'm saying? So candlesticks is what matters here. So when you take a good look here, this your low of the market, your high of the market, your low of the market, your high of the market, your low of the market, your high of the market, your low of the market. So this is the 4-hour time frame, all right? So this is the 4-hour time frame. And basically on the 4-hour time frame, what we're gonna basically anticipate is that the market gave you the first change of character. Now, when you get a change of character, you should anticipate for the market to retrace back down to fill some type of zone, whether it's an order block, whether it's a demand zone, whether it's whatever. So the thing is like, this is technically where you can start scaling down and all that kind of stuff. So when I scale down, I'm gonna go to the 1 hour. When I go to the 1 hour, I'm still obviously bullish because of that change of character that occurred right here. Then when I go to the 30-minute, I'm still obviously bullish, all that kind of stuff. You know what I'm saying? And then when I go to the 15-minute, I'm still obviously bullish again. Then when I go to the 1-minute time frame, so I can't go that far back. It's not gonna let me go that far back. So give me a second. So let's kind of just play around with maybe something that's gonna allow me to go a little further down. Okay, I'll just stick with the 5-minute time frame then. Maybe like right there. So when we go to the 5-minute time frame, what's gonna happen is within that breakup structure, you're gonna apply the same concept to the lower time frame. So when price starts making higher highs and higher lows, the things that you want to start looking for sells because you're trying to sell your way down to that retracement of the market. So let's go up to the 4-hour time frame. Price will not just keep going up in an unhealthy way, all that kind of stuff, you know what I'm saying? So the thing is that we want to see where price is potentially going to reject. All right, so there's gonna be 2 examples here. So now you can use what we call a zone, which is right there. That'll be your first zone in price action because there's several rejections that occur in this area. Or you can use the potential of a breaker block. We're not gonna go over that right now, that's on Sunday. Or you can use what we call an order block that we're not gonna do that Sunday as well. So the thing is like, I'm trying to keep this retail as possible, but the thing is that this one works based off institutional trading. So I'm just gonna just babble until something clicks for retail. All right, so that's what we're gonna do for that one and then go from there. Okay, so in that given aspect here, I'm really expecting the price to come back down to this given area before going back up. But like I said, that'll be explained on Sunday. But as of right now, since we're expecting the price to come back down to retrace, create healthy price action, you should be looking for sales in that given aspect. Now, the reason I know price will sell here is again, order block. So basically in this given aspect, this liquidity concept sitting up there, that's also gonna be covered tomorrow. So let me try to find a way to navigate. Also, for the person who asked me to zoom in, you should also be able to zoom in on your phone. So that way, because I have a really, really large screen. So it's really long, you know what I'm saying? So I'm trying to make sure it's not too close up to me and all that kind of stuff. So as you can basically see here, we're still in the 4-hour time frame, but normally, like I told y'all, I don't waste a lot of time on the 1 hour, 2 hour, 3 hour, 4 hour, all that kind of stuff. When I see something in the 4 hour, I'm jumping straight down to the 5-minute time frame immediately, just right away. Like I'm not gonna waste my time on the higher time frames. So now if you take a look here, when you zoom in, what's gonna happen here is that if I zoom out for y'all and go back to the replay button, here's a great example of how to basically look at this. So you're gonna notice how price is making highs all the way up here, right? And then the moment price rejects, make a higher low, then a higher high. Okay, if not, we can make this a higher high. So the moment we go bearish inside this supply zone, which we're going to learn on Sunday, you'll basically see how this will give you the reason to start selling. So what we're waiting for is a change of character, a reverse in price action. So when you get a reversal in price action, that's going to tell you that you get your first sense of change of character. Then you should start looking for sells. So if I click play, price going to do whatever it wants to do. Then you're going to see how we get our first change of character that occurs there. So this means a change of character to the downside. So what's going to happen here is that you want to wait for price to break structure to the upside. In other words, come here, like retest this given area. So if you take a look here, you can see how this area is a strong zone of resistance. Okay, so basically what we're expecting is for price to do something like this. So this is how you combine using market structure with zones, or that kind of stuff, you know what I'm saying? And basically you can anticipate the price to just go all the way down. All right, so in this given aspect, you can also create, make this become a head and shoulders. Because if you basically take a look here, this would be your shoulder, your head, and then the price rejects here, your shoulder. So if you could play, you're basically going to see that, and you're going to see how price swiftly comes up here, creating that shoulder level, which is right there. And of course, your stop loss will be up there because that's the high of the market. So in other words, what you're really going to be doing is basically getting your short position out, getting right here. Let's go right here, getting your short position right there. And then your stop loss will be at the high of the market, which is basically right there, because you can see where your stop loss should be up there. And then you're also going to notice how I'm on the 15-minute time frame or any of that kind of stuff. The thing is that if I stay on the 15-minute time frame, my stop loss will be a lot bigger. All right. Now, in this given aspect here, and click this, and then you'll see how price makes this high, and then go from here. And then now, if you remember that I had my zone like all the way, like my POI, meaning my point of interest, like where I want price to go, was like a little lower. But then again, we're just gonna keep it right here for now because that's the next projected zone in the market. Because if you take a look here, that's a pretty strong zone in the market. So what you're gonna do is bring out your rectangle and do something like that. And then you can tell yourself that you want to take profit right here. So about right there. And then when you click play, it's just gonna, go all the way down until you hit your little zone. And then now you hit all price targets. So do you basically see how I started with the higher time frames? And I know the higher time frame is bullish, but because I understand the concept of self-structure and all that kind of stuff and unhealthy price action, I scale down to the lower time frames in order to find a potential sell to go fill that healthy price action in the market. So if I go back to the 4-hour, you're basically going to see how price is basically reversing back down to the downside to come potentially fill this zone here or fill this zone down here, all that kind of stuff. Am I making sense so far? What do I basically mean by why I went from the 4-hour to the 5-minute? Now, normally I don't use the 5-minute time frame. I use the 1-minute time frame. But if I go back so far, price is going to basically, like TradingView is gonna take me out of the thing. Okay, so let's go back to the 5-minute time frame, and this was a 1-for-8 ratio. So the thing is, most times my ratio is about 1-for-10, all that kind of stuff. If I take you to because I know if I take you to EU, I'm going to show you how EU was found as well, all that kind of stuff. Okay, and it's just using market structure a lot. So how you identifying the zones again? So the way I identified King Major, don't watch any YouTube videos. Just wait for me to go through day 2 and day 3. Do not waste your time on YouTube because you're just going to confuse yourself a lot more. You know what I'm saying? So don't watch any YouTube videos on this. Wait for me to cover day 2 and day 3 because that's really how I combine. Don't even rewatch the video. You don't have to watch it. The thing is that I just need you to understand the concept of market structure. But when we get to day 2 and 3, everything's just going to start clicking like right away. Because the issue here is that I haven't covered order blocks. I haven't covered liquidity. I haven't covered breaker blocks. I haven't covered like mitigations, inefficiencies. So the thing is like once I cover all those things, you're gonna be like, oh, I see why you are selling up there. Oh, I see why you are blah 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 blah. You know what I'm saying? All that kind of stuff. You know what I'm saying? So in that given aspect, HFX, nah, not even. No, you know what I'm saying? So basically, like I'm basically saying that's basically how I got that concept right there. So like I said, now we're just gonna go from there. Okay, so we're gonna click play, As you can basically see, price is creating lower lows and lower highs, so which is why price could keep on going down, down, down. So I won't start looking for buys until I get a change of character to the upside. So technically speaking, it's where I got my first one, but momentum, I'm going to teach y'all momentum on the third day as well. You know what I'm saying? All that kind of stuff. Will we cover Wyckoff method? The answer is no. That one takes way too long to teach. I'm sorry. I do cover that in my course, but no, we're not going to cover that here at all. Like it's not gonna happen. It's just it takes a long time to teach all that kind of stuff. You know what I'm saying? So we got a first change of character here. Now we're gonna see how price reacts in this zone. Because if you take a look here, it's a pretty nice zone sitting in price action. So don't forget again, I'm just trying to use y'all's method. I'm sorry, Sire's method, because he taught y'all his concepts first. I haven't taught y'all anything yet. I'm just trying to teach y'all how to identify where the market is going. So that's the first thing we covered today. Now, entries, stop loss, understanding fake outs, all that kind of stuff won't happen until day 2 and 3. All right. Then you're gonna start learning how to combine every previous day together. So day 3 is really where everything is gonna be goes together. And then you're gonna be sitting there like, oh, like whatever, you know what I'm saying? So like I said, basically today I just need y'all to understand the concept of change of character, break of structure, like all this kind of given concepts. You know what I'm saying? So as we can basically see here, that was the order block. Well, sorry, let me disregard order blocks, all that kind of stuff. Sorry. So as you can basically see, I knew, or rather I understand why price came this low. I wouldn't even bother buying here based off the way I trade, but based off the way y'all trade, this would have been a potential buying zone because of break of structure to the upside and zone or whatever, you know what I'm saying? But the issue here is that there's excessive momentum here in price action. So basically speaking, you should even take the trade there. So now you can also see how price broke structure to the downside right there. And I just noticed I forgot something. There are 3 types of break of structures. Okay, so you're gonna have a candle break of structure and you're going to have a wick break of structure. So what I mean by that is if you take a look here, do you see how if you were monitoring this low, then you will notice how this little line closes under, like the candle itself closes under that previous candle, which means that's a break of structure as well. Because there's gonna be times where you see price do something like this. So price might do something like this, and then the body no, the candlestick might close above this level, okay, but the body doesn't. So what's really going to happen is price just keeps going down, and you're going to think, oh, I thought that was a change of character. The answer is no. I don't use candlesticks as change of character. I'm sorry, as break of structures, unless there are multiple wicks to the downside breaking that level. Then yes, it's a break of structure. So as you can basically see here, price failed to close under several times, all that kind of stuff, or rather, you can see how there's a full break of structure here. As you can basically see, but like I said, it's a fake out. And the thing is, when you go through your when you scale through the time frames, you'll basically see like price came up here, and you start learning how to scale through the time frame. So this 10-minute time frame concept, this order block took out this low, so price was just coming to this level to retest it before going to the upside, all that kind of stuff. So price might just be coming up here and then going back down, all that kind of stuff. So as you can basically see, we hit the wick of this price action, and now we're going back down to the downside. So all we want to do is focus on waiting for a change of character to the upside and waiting for momentum to slow down or volume. We will cover that on day 3, so don't really worry about it. And until right now, we're basically waiting for a nice change of character. So as you can see, you see how the wick closes above, but the body doesn't. So which means that price has the ability to keep going down and not go back up. You know what I'm saying? So be careful there. But then you did get a nice rejection here. It says, I better look at the wicks. I always look at the bodies. So when you pay attention to the body, pay attention to the body, all that kind of stuff, you know, stuff like that. So you can basically see your first fake out occurred right there. And the thing is that what this did for me here is that based off structure alone, you will see how this low here create a new high based off this break of structure. But if you take a look here, the momentum concept compared to price coming higher, it's clearly that momentum is favoring the downside. So if I push price here, where you can see this, you're going to see date range. And if you take a look here from that lower wick to that high right there, you're going to see that it took 17 bars to get there in an hour and 25 minutes. Whereas it took roughly 4 bars and 15 minutes to get all the way down here. So if you try to buy here, it's going to hit your stop loss. So this is what I call the concept of momentum, basically meaning price action is favoring the downside. Sellers are in control. In other words, this is one way to, like, let's say you don't understand your zones that well. No problem. Like, use the concept of momentum, and basically the tool you're going to use what we call the date range. Okay. And basically you're going to measure the low to the high, and then the low to the high, then the low, then the high to your potential rejection zone. So if price gets to your potential buy area and you want to buy here, hypothetically speaking, you're going to measure every candle that it took to get there. So let's say that you want to buy right there. You're going to see the first reaction. It took 2 candles to get there in 10 minutes. In other words, 2 candles is way faster than 17 bars an hour, 25 minutes. So what that tells me is that sellers are in control. Okay. And basically it's going to hit your stop loss if you try to buy there. So as you can basically see, if you try to buy right there, more than likely you're going to hit stop loss. All right. And all that kind of stuff like that. So what I'm really waiting for is price to really settle down. So the thing is that even though this will be your stop loss of the market, you can see how price is still holding you in. And then for retail traders, like let's just say that you buy here, your stop loss down there, they'll come out to break even right here, or rather they'll be in profit again. And then you're going to see how to retest this area one more time. Price goes higher, so they enter more positions. And what happens again? Prices come down excessively, takes them out of the trade. So now we grab liquidity. Like I said, we're going to cover that on Sunday, but let's focus on structure here. So now what I'm really trying to do is just keep monitoring this until I get a break of structure to the upside. Now, you don't have to keep Vanessa, don't worry about the candles. I mean, the wick. Like I said, the wick is something you don't really want to use. Like I would suggest that you use more so focus on the concept of using let me kind of just clean this up a little. So if you take a look here, do you see how you would consider this a breaker structure? Because that wick closed up above that wick, that would be considered a breaker structure to some people. Now, do you see how price comes up, then goes up, then it comes down excessively, then starts to consolidate here, then breaks structure to the downside? That's because it's a fake out. So when you start learning how to actually correctly identify your market structure, you're going to start really seeing where the price action is really going. Okay. And of course, when you take a look here, this is what we call order block concept. So obviously I can see why price went down. I just can't explain to you right now because we haven't gone over liquidity, we haven't gone over order blocks, we haven't gone over failure of structure. So the thing is, like, all these things will explain why price reacted here as opposed to mitigating here. In other words, this is why your entry should have been right there to the downside. Of course, you could have profit right there. Very small stop loss. Maybe your ratio be roughly about, I would say, let's just take a look here myself. Like a very skim stop loss about right there, and you'll sell it all the way down here. So a ratio of 1 to 6, you know what I'm saying? So basically, you won't get that concept until at least Sunday, maybe Tuesday, if you're a fast learner, all that kind of stuff. But as right now, we're still bearish, as you can see, and all that kind of stuff. And this is liquidity, so this is not the high of the market. Okay, so you'll learn that tomorrow. So basically, the high of the market and the low. So price does not come above this area. If price come up this area, you are still bearish. So you can basically see how price comes over here. You can see how it gets wicked out. And now you're thinking, oh, we are bullish, but then again, you get faked out, excessive momentum downside. So we might see price react here or something, and then go down, or something like that. As you can see, price kind of reacting the area. It might just go a little higher, who really knows, all that kind of stuff. And as you can see, price reacted it pretty nicely, but then we're getting one more push up to the upside to take out more liquidity concept, like I said, Sunday. But then again, price can also come here, but there's liquidity grab there, but we're focused on structure. All this here is practically invalid market structure, all right? Because price does not close under until price really gets right there. But technically speaking, that's still the high of the market. But when you have all the liquidity sitting there, your market structure will remain the same. So that's your high of the market and your low of the market. So based on right now, you keep technically holding the trade to keep your position open, all that kind of stuff like that. And then you're gonna start seeing how price comes all the way up here, takes out all the lows, and then okay, so price lines take out the overall significant low right now, which is right here. So basically speaking, we're still trying to figure out what's going on. And then, like I said, as long as prices take out that high, we are green. Let me check the 4-hour really quickly. Yeah, I'm still expecting the price to go a little lower. So honestly speaking, we could be in this area for a long, long time. But really, is there any liquidity sitting here? Maybe here. Let's take a look here. And by the way, this, like I said, price still hasn't closed above this area, so we were still bearish. And then you see how price runs off after that. But what really happened here is that price filled this inefficiency, or rather 50% of price action. And you're gonna notice how even though price hit this area, we never truly closed, price never closed under, okay? So basically the low that created this area, you can see how price never closed under. So basically your position should have still been open based off structure alone. So basically price comes up to this area to test it one more time. And when it tests it one more time, you're gonna see how basically you get your entry up there. And then price takes its way all the way down to the lows of the market. And I should say this whole entire way we're bearish. Now, I'm gonna understand why price does something like this. So if you don't fully understand price action, just use another way to get fooled out. So if you take a look here, you're gonna have what we call a channel, like a bearish channel, or rather a falling wedge based off all that kind of stuff. So if you don't understand structure alone, you'll see here how like this potential fake outs in the market. So if you take a look here, this would be your low, then your high, then your low, then your high, then your low, then your high, then your low, and then price comes all the way up here, but makes a new low. So even though price came over here and broke this partial fake high, you might think that, oh, price broke this high, we're bullish. No, that's not the concept here. Because I mean, take a look here, we might get a change of character right there, but in reality, what you want to focus on is the area that breaks significant structure, which is right there. So this area doesn't really break any structure to the downside fully. You can see how it equally stays under there. So when price comes over here, price goes all the way down, which is why that's your high. So basically speaking, that's why when market breaks out to the upside and you're trying to get buying positions in this given area, it's not going to work out. Okay, so you probably enter like try to buy here, and then you get the retest, then price goes up excessively. So now you're thinking you're in profit, all that kind of stuff. But price happens down, price just comes down and it takes you out of the trade because your stop loss would be in this area. So basically you hit stop loss because you don't understand structure. You know what I'm saying? So basically it's the same concept of market structure. Now, market structure still gets a lot more in depth. This is really just the basics, like I'm basically telling y'all. Yeah, like I told, it took me 6 months, you know, it took me 6 months. So it's just a like general grasp of it, okay? So basically you can see structure still doing its thing. We're still bearish as of right now. I'm trying to wait for a true change of character. And as of right now, like price is still doing its thing. And the thing that you can see, price comes over here to fill this inefficiency. I'm sorry, not inefficiency, order block. And then I don't like pre-market doesn't matter to me. Post-market doesn't matter to me. Like I only look at structure when the market's alive, you know, saying like open, you know what I'm saying? So basically pre-market, post-market, gaps, news, banks means nothing to me, you know what I'm saying? Pay attention to the structure, you will know where price goes. You know what I'm saying? All that kind of stuff. So as you can basically see here. So you can see price still doing this thing. Loss of structural liquidity here. So that is not counted as a high in the market. So basically we're still gonna need price to break that high in order for, in order for us to basically have a change of character. So you can basically see price doing this little thing. And then we can see here how price basically give us a change of character right there. So when that change of character occurs, what's really going to happen here is that we may see price. This liquidity right there. That means the low of the market that mitigated right there, and this inefficiency. This inefficiency right here. So basically, let's take a look right there. Nah. So we are going to see price potentially come down to this area. depending on how price wants to react here due to liquidity concept, then again, day 2, but based off market structure alone, this is the low of the market. Okay, this is the low of the market, and this is the high of the market. So basically, you might see potential rejection in price action here. All right, and then since we're still overall bullish and there's so much liquidity sitting here, I'm anticipating for the market to maybe come retest something up here. I don't think price is even going to hold, but if it does, I think price will reject here. So basically what I'm trying to see is that price might do something like this and continue the downside. But since we're on the 15-minute time, we're just going to take a look at ourselves. So you can basically see, price reacted to where I was basically expecting it to go to, all that kind of stuff. And when you get that nice reaction, like I said, I'm still overall bearish on this given pair because of the fact that there's several things that I'm seeing, which I can't really explain right now because it's going to create confusion, all that kind of stuff. So I'm trying to keep it like that. What time is it? Like, how long have I been talking? It's 10. Okay. So let me keep going. You know what I'm saying? So I lost track of time, all that kind of stuff. But before I continue on, is this making sense to y'all? Like, is it actually making sense? Kind of just got caught off guard. So is it making sense? And is it actually making sense so far? So that's what I'm trying to figure out. You know what I'm saying? Let me just kind of check something, all that kind of stuff. So Nathan said it's not making sense so far. It makes sense, but damn, okay, but keep going. Okay, trying to keep up. So like I said, I have the highs and lows. So yeah, yeah, you know what I'm saying. So like I said, market structure is what takes the most, you know what I'm saying. But tomorrow, when I apply liquidity, you're gonna start seeing why market structure does what it does, like why it moves the way it does. You know what I'm saying? So basically, day 3 for my teaching, I don't expect most of y'all to understand this until day 3. You know what I'm saying? But with Sire, like you should understand the very first day. Very simple concepts, all that kind of stuff. Yes, way more difficult. This concept is way harder. I'm gonna tell you this right now. Don't think this is just some type of thing you can just grasp and it's gonna make sense. It's not gonna happen. You know what I'm saying? It's not happening at all. I'm not gonna tell you that right now. Stuff like that. So what I want you to understand is that this concept takes a lot more time to learn, but you will be a lot more precise in the market. You will be able to identify the actual precise entries, fake out of the market. You will know where the market is going. You will not have to use use news anymore. You want to use liquidities anymore. You're not gonna have to use indicators, chart patterns, support and resistance zones because they're all delayed information. They're all information that you have to rely on. For example, when you're using zones, like everything in the market is a zone. You know what I'm saying? So my thing is like, if you do want to trade institutionally, be my guest. You know what I'm saying? It's gonna take some time to click in, all that kind of stuff, and go from there. All right. So that is definitely one. All right. So let's just go ahead and see how price reacts here. All that kind of stuff. It says it's only because it's new to most of us. Yeah. So yeah. So yeah, repetition is always gonna be the best key. All that kind of stuff. You don't have to master Sire's way to understand this. Getting fluent in Sire's way, it's not even Sire's way, just that's called retail trading. Getting fluent in retail trading is what's going to allow you to see what to avoid when you're trading institutional trading. Now, if you just start learning institutional trading, you're going to be precise regardless. You know what I'm saying? But the thing is that you're not going to know anything about chart patterns or support and resistance zones, all that kind of stuff. You know what I'm saying? So you won't really know what to avoid, but then again, it's already going to be avoided because you learned one concept. It's just that understanding retail is just beneficial. All right, all that kind of stuff. So as we can basically see, price has risen up just like I was anticipating. And the thing is like, if you notice, I went from the 5-minute time frame to the 10-minute time frame. And like I said, it's because I can see a lot more given things on this chart, structural liquidity, all that kind of stuff, change of character, things like that. So in this given aspect here, my ratio would probably been about, I don't really know, maybe I'll say like a 1-to-6, maybe. Who knows? So that's about 56, and then so a 1-for-6 ratio. But then again, I can definitely scale it down and make the stop loss a lot tighter. But the thing is, I can't go to the 1-minute time frame right now, unfortunately. So it's okay though, you know what I'm saying. But as you can basically see here, All right, we can basically see here how price react in that given area. And then assuming you wanted to start selling from here, you're more than welcome to, you know what I'm saying? Then you get your position from here. And then you'll see how every single time it's a new precise mode. I don't waste any time in drawdown, you know what I'm saying? Every single, and my stop loss is gonna be 13 pips, probably gonna be about like 7. And then you start scaling all the way down there, you know what I'm saying? But the thing is like, I don't know if it's fully gonna go. The ratios are basically gonna show your risk versus reward. So basically, you always want to make sure that your ratio is above 1 to 5. If it's not, it's unnecessary trade. You know what I'm saying? So the reason I trade ratios because one, if I trade a ratio on a 100K account, well, forget about 100K. Let's just speak in the matters of y'all. So let's say y'all is trading with $100 and you use a ratio for 1 to 10, you will flip that account from basically $100 to $1,000. You know what I'm saying? Because ratio does, I mean, you don't have to understand ratio right now. Just understand that ratio is just simply the concept of risk versus reward. And the thing is that this toolkit here, which is called short position, will tell you how to, navigate there, all that kind of stuff. You know what I'm saying? So in that given aspect here, you will basically see that ratio will just tell you how much you're risking versus reward. So the thing is that the tighter your stop loss is, the more you can risk on that trade. So if you know your very precise stop loss, go for the highest contract as possible because you know you're gonna be able to get out of it fast if you hit stop loss. You know what I'm saying? So basically, if you have a $100 account, you can risk the entire account. You know what I'm saying? So basically, you lose $1 to win 10. Basically, yes. You know what I'm saying? But on a $100 account, you can basically call. I'm not saying yes to calling anybody pieces. That's what I'm saying. I was saying yes to risk to. I'm saying yes to basically saying lose $1 to win $10. All right, that's what I'm basically saying. So I'm just saying like let's just keep it more realistic. All that, you know what I'm saying, stuff like that. So basically, if you risk this correctly and you use the correct ratio, you can literally turn $100 to 1,000 in one trade. You know what I'm saying? Assuming you have the correct ratio. Or not, you know what I'm saying? So yeah. So let's click play. So as you can see, price is just doing its little thingy. It's going down, all that kind of stuff. And as you can basically see, we're still in profit. Like I'm saying, we target the liquidity to the downside. Now, if you want to be very simple here, you don't want to swing or anything, then you can basically just see how price targets the liquidity right there. So now your ratio is 1 for 8 in that given aspect. So let me tell you this right now. I'm freestyling this right now. I can see every single little thing. I know where the price is going to go regardless. You know what I'm saying? So the thing is like, I'm able to see it all. So I just always know where price is going. No, I did not freaking practice it before I can. I'm gonna be stupid honest with you every single time. All right. Like I literally don't, I'm telling you right now. If you learn to trade institutionally, every single thing can literally be predicted in the market. Now, just know you're gonna be learning this straight for about 6 months, just losing for 6 months, or even a year, or even 2 years, or even 3 years. You know what I'm saying? Because let me tell you this right now: if you trade stocks, whatever Sire is teaching you, you're better off just using that. You know what I'm saying? Because it's pretty simple. It's just breakouts. You know what I'm saying? Like, who can't trade breakouts? You know what I'm saying? Like, it's the most simplest thing that you could possibly trade. Same thing here. Let's just say that you want to use this as a breakout. Just draw a line right there. When price breaks out, enter a buy. You know what I'm saying? Pretty simple, right? Yeah, that's all we need to know. Now, institutional trading, if you are trading institutionally, here's the difference. You enter down here instead of entering up here. Now, on an option contract, let's say that's Tesla, that could be a $400 difference, $300 difference, $200 difference. Like that's a lot of money that you're just missing on the table from not being precise, or at least practicing and mastering the craft of being precise in the market and all that kind of stuff. You know what I'm saying? So basically what I'm saying here is that all I really showed y'all for today is market structure. And like I said, market structure does get a little more complicated. You know what I'm saying? I just showed you the basics. And for the basics, it's complicating. Yeah, it is. You know what I'm saying? It is. It's a complicated process. You know what I'm saying? I don't expect any of y'all to get it in a day or even by the end of this boot camp. It's not happening. You know what I'm saying? Yeah, all that kind of stuff. So this is just the basic institutional trading. So this is where can you get my institutional course? I never talk about my course personally. I'm just gonna be posted tonight. I don't really talk about my course personally. I really just keep it on my social media. But Anything related to course material, I'll just really discuss that on Sunday. Other than that, that kind of stuff. Is that so? Yeah, so with that being said, let's go ahead and see how this plays out to the downside. I'm just gonna unclick play and then show you more potentials. Like price probably gonna come up here. If you use the breaker, you might have got an entry right there. And if you take a look here, there's another entry right there, but all right there, just like I said, it hit you precisely. So now we're going down. Inefficiency in price action, but we did not miss it because we had a breaker right there. Target liquidity, hit order blocks, more liquidity concept, we hit the breaker right there. So the thing is that when price does all that, we're targeting these lows every single time and hitting price action. Now, don't know where you're going to notice here, there's a bunch of liquidity sitting up there. So that tells me that price might come all the way up here and then go all the way down there. You know what I'm saying? That's the potential what could possibly happen. But then again, it's the 5-minute time frame, all that kind of stuff like that. So if not, we don't have any change of character until price gets here. You know what I'm saying? All that kind of stuff. You know what I'm saying? Yeah, definitely. So like I said, the things for Jose. So the thing is that the issue here is that you can't enter trades just based off market structure. So that's why I'm literally showing y'all these concepts of liquidity or order blocks, even though we haven't discussed them. But the thing is that I'm trying to show you how to potentially enter the trade with what we're going to learn on Saturday and Sunday. So the thing is that keep these order block concepts out of your head, keep liquidity out of it, but just focus on how I'm using structure to predict the market. You know what I'm saying? So everything's based off structure. If you pay attention like really well, then you'll basically see like, okay, the market's doing, you know, yada, 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 all that kind of stuff, you know, stuff like that. So as you can basically see here, will price get there? I don't know. Like you see, as like I said, basically that's the change of character location. Price has not got there. Is there liquidity anywhere else here? No, I know there's a change of character right there. Price. I was muted. Okay, never mind. So like I'm basically saying, you will basically get the bigger picture of it as time starts going on. Okay, and I was gonna show you all the concepts of it, but let me just start right now because you're gonna start getting more confused. Okay, and I want you to get more confused. All right, so that is definitely that. It's 10:14. Been for about 3 hours now. You know, so but at that again, I just say it's gonna go between 2 to 4 hours per day, all that kind of stuff. You know, so that is that. So with that being said, the recording will be posted tonight, and then I will upload it into Discord. So make sure you're in the Discord. I'll also upload my PDFs into Discord, all that kind of stuff, and then all that kind of stuff, right? So, but before I go ahead and get out of here, questions? Any questions? You know what I'm saying? Any questions? it's just quick. Oh, you're supposed to do question game, but yeah, I got a little all that kind of stuff. But we can do this tomorrow. So you can do tomorrow. We're gonna do a wrap up, and then I'm basically gonna tell y'all like is this bullish or bearish, and then is it bearish or bullish, all that kind of stuff like that, and then y'all will tell me. All right. So basically, you don't have to rewatch my part until really like day 3. You know what I'm saying? It says, do you have any off-white shoes? I have 2 of them or 3. I think I'm 3 or 4. Oh yeah, it's all that kind of stuff. You know what I'm saying? But yeah, I mean, there's more shoes over there, but either way. But you know what I'm saying? So that's definitely one. You know what I'm saying? All that kind of stuff. But with that being said, do we possibly have any other questions? I am Igbo. I'm Nigerian. Not that. Yes, I am. All that kind of stuff. So that kind of stuff. Silk PJs. Yeah, that's all I wear. I have like a huge collection of silk pajamas. You know what I'm saying? Will my Wi-Fi be fixed tomorrow? I don't know. I live in the middle of nowhere. You know what I'm saying? So we'll see. Let's just hope that it's fixed. Like I said, this is actually my first time having issues. You know what I'm saying? So yeah, I love the PJs too. You know what I'm saying? I think tomorrow we're going to wear a gray PJ. On Sunday, we might wear pink or black, maybe even purple. We'll see. Like I have a whole collection of them. You know what I'm saying? Me and Kelly are not siblings. We have similar last names. She's also Igbo. So my thing is in the Igbo culture, basically speaking, in the Igbo culture, basically, our last name is very common. But the thing is that my family line added an I before the A. So that's how we have Ogbonnia. But then her last name is pretty much the same exact way. I kind of see what I'm saying. So it's trading my full-time job. I haven't had a job in a long time, but I've been fired from every job I had. You know what I'm saying? So basically, I think I've had like 12 jobs and fired from every single one of them every time again and again and again. You know what I'm saying? I just couldn't really work for somebody. You know what I'm saying? So that's that, all that kind of stuff. So it says all that kind of stuff. You know what I'm saying? So that is definitely one. Stuff like that. It says, do you work for a firm? No, I don't work for nobody. You know what I'm saying? I mean, I work for Kelly, yeah, but this is more very simple concept that I'm working for the Discord, so I don't see it as looking for Kelly, all that kind of stuff. You know what I'm saying? I remember I told her, like, I told her I don't work for you. Like, I literally told her with my mouth. You know what I'm saying? So all that kind of stuff. But Sire used to work for Goldman Sachs, all that kind of stuff, stuff like that. You know what I'm saying? But you know what I'm saying? I don't want to be put in the principle that I'm working for nobody. You know, because I mean, technically I don't. You know what I'm saying? But yeah, Sire did work for Goldman Sachs, all that kind of stuff. I mean, I got hired to Goldman Sachs and JP Morgan Chase, all that kind of stuff, but I only wanted to work for fun. You know, so I still have the offer on the table just in case I feel bored. Because I mean, I'm bored. I'm definitely bored right now. You know what I'm saying? But yeah, that's that. You know what I'm saying? But let me kind of stop the recording real quick. It says stop recording.